In London with Tom McKenzie.
And here are your top stories. HSBC profit crushes estimates as the bank says it will repurchase as much as $2 billion of stock. CEO Noel Quinn tells Bloomberg exclusively there may be more to come. JP Morgan agrees to acquire First Republic in a government-led deal for the failed lender. The takeover comes as Morgan Stanley is said to be planning 3,000 more job cuts as deal-making slumps. And the Aussie dollar jumps after the RBA unexpectedly hikes rates. Stocks are mixed as the Fed prepares to meet. And Treasury Secretary Janet Yellen says the US risks running out of cash as soon as June the 1st.
Tom, for the moment, if you look at futures, they're actually holding on to gains. A lot of the focus is also on the fact that swap traders has boosted the odds that the Fed will raise by a quarter point. And then the other focus, of course, that economic data later out of the Eurozone, and that will give us probably a good indication of what we can expect from the ECB.
Yeah, so we have the economic data, as you say, out of the Eurozone. The economic data out of China, by the way, pretty mixed. Manufacturing surprising many of the economists by coming in actually lower, even as services, particularly around travel and leisure, improves. When it comes to the earnings picture, of course, two big stories for us. BP, HSBC as well. We've been talking exclusively to the CEO there. A surprise special dividend coming to play. We'll check on the bank stocks in just the next few seconds. When it comes to the UK, by the way, markets now pricing in 5% from the terminal rate from the BOE. We focus, of course, on the Fed and that decision tomorrow, and to what extent these banking risks have been put to one side, neutralised by Jamie Dimon and the team over at JP Morgan. Currently, the French CAC on down 0.4%. The Spanish IBEX is flat here in the UK. The FTSE 100 also unchanged, essentially, just in the first few seconds of this open. Let's switch it over and see how things are shaking out across these asset markets. The focus, of course, on the Aussie dollar after that Aussie surprise in terms of 25 basis points, the hike coming through after a pause the previous month, and flagging as well officials at the Central Bank of Australia that potentially further increases and further tightening is potentially in the pipeline. So those are the gains there for the Aussie dollar, 1.2%. The futures in the US flat. The 2-year at 4.12. You're seeing a bit of movement in terms of yields ticking up on European debt yields. And Brent, still below that $80 a barrel, $79, currently unchanged. The China component at play there as well, again, on weaker than expected manufacturing. Let's check in then on the banking sector. HSBC to the fore with that profit beat, and we were hearing and we'll get more details from the CEO. Again, the special dividend, but also the share buyback around $2 billion. So a decent gain there for HSBC. Look at that, gains of around 4%, and to what extent that lifts the broader banking sector. Tying into this, of course, is some relief that came through. You saw that reflected in JP Morgan's stock price yesterday after that deal to take over First Republic. But the risks further down the line, later on, around an ever larger banking group that is JP Morgan, is something that some have flagged. UBS currently just up 0.2%. Over in Germany, Deutsche Bank getting 0.5, and Barclays is currently flat. Fran.
Yeah, a lot of the focus, of course, is on the earnings, as you beautifully laid out, Tom. So the focus, if I look at the 20 groups that make up the Stock 600, so I have about 4 gaining, and they're not gaining by that much. We have banks on the up, gaining 1%, retail auto parts around 0.5% higher, and then we have healthcare definitely leading the declines. We have media, telecoms, and energy 0.8% lower, Tom.
Okay, so is this the warning shot then from the RBA when it comes to expectations from the markets that the Fed will hike and then pause? Is the Aussie movements and the decision-making from the RBA after that pause and then that surprise hike, something of a template for other central banks out there. The Aussie dollar, as you can see, up 1.3%, jumping after that surprise hike by 25 basis points, of course, and the Australian stocks as well slid as much as 0.9%. The three-year rates are now heading for their biggest intraday jump since September. Bloomberg Economics now sees this as the RBA's final hike. Let's get the analysis then and bring in Bloomberg Markets Managing Editor Christine Aquino. Christine, what are the implications then, are there, for the other central banks? To what extent will they be reading anything into the RBA's surprise decision?
Well, Tom, as we know, Australia is a small, open economy, very exposed to inflation undercurrents coming from the U.S. and China. And so this is very much a blueprint and a lesson for other central banks as to how a potential pause might play out. They might end up kind of pausing for a little while, or like the RBA, pausing for one meeting and then having to double down on those rate hikes the following meeting. And very interesting messages from the RBA as well. They've definitely alluded to the tightness in the labor market, the same kind of tightness that we're seeing in various other economies, including the UK. And so, you know, all of these kind of factors really just pointing to the fact that inflation is proving to be a persistent issue in Australia and something that other central bankers across the world will probably be keenly watching.
So, Christine, it's a surprise, but how does the decision impact credibility actually for the RBA?
Well, very good question, Francine. I mean, that is, in fact, what a lot of investors, market participants are trying to discern now is that, you know, especially for the RBA, we saw the pause last month, and then now they're raising rates. They're kind of U-turning back on themselves. And I think this really does show that it is quite a difficult job communicating these policy moves by central banks, you know, because they don't want to paint themselves into a corner and say that they're going to be doing one thing, but then the data ends up surprising them, and then they're having to backtrack. We've seen similar moves as well from the Bank of England, with inflation just repeatedly surprising policymakers. And so this is, again, a lesson for a lot of central banks out there. You know, they really want to give themselves optionality when it comes to mapping out policy moves, because you just never know if the data is going to surprise to the upside yet again.
Christine, we have the earnings story, of course, front and center, but also the deal around First Republic, and to what extent it does neutralize those banking challenges. How are the markets reacting to the news around, again, the mega bank that is JP Morgan and the solution around First Republic?
Well, Tom, there's obviously a little bit of relief, of course, with the fact that JP Morgan has stepped in for that First Republic rescue. But again, I think questions are still lingering across markets. Where is the next shoe to drop in the banking sector? I mean, we've seen now repeatedly banks kind of being in a firing line for investors and thinking that, you know, some of these kind of weaker hands in the banking sector are starting to get exposed. And so now that we've seen Credit Suisse, the number of banks in the U.S., and again, now First Republic, it just kind of raises that uncertainty and speculation over whether there's going to be more that will have to be rescued, will have to be taken over, and how much capacity do the bigger banks have when they're going to have to keep snapping up some of these smaller banks to prevent them from failing. Big questions hanging over markets still, and it's likely to generate some uncertainty.
Christine, overall, what do you think will be the main drivers for markets in the next couple of weeks? We have a lot of earnings, then we have that debt ceiling conundrum, and then there's so many questions about, for example, you know, what happens to the banking sector, also a couple of, you know, I guess challenges, legal challenges for Credit Suisse.
Absolutely, Francine. I mean, you know, you mentioned the banking issues. You mentioned, of course, things that are happening when it comes to the debt ceiling. I mean, that's something that's a worry that has been latent over the last few weeks, but could potentially come to a head sooner than markets expect. And then, of course, it's Fed week this week, right? And so there's definitely a number of things that market participants are going to have to pay attention to. I think it will ultimately boil down to the balance between, you know, some of these uncertainties and worries over the markets, and whether what we hear from authorities, whether it's the Treasury in the U.S. or the Federal Reserve, what we hear from authorities when it comes to how they're going to be addressing some of these issues, and whether the worries that are latent in markets at the moment, particularly in the banking sector, is that something that's starting to inform policymaking as well, something that's very important to be watching out for, particularly when we hear from the Fed this week.
Well, let's flesh out one of the uncertainties that you and Fran have mentioned there, which is the debt ceiling. And of course, we'll be getting the latest in terms of reporting around the politics of this later in the show. But in terms of the market reaction, the market pricing, as the clock ticks down potentially to just 4 or 5 weeks away from this deadline, Christine?
Absolutely, Tom. I mean, you know, the history of the markets dealing with a debt ceiling, it really is one of these things where they just don't worry about it until it's time to worry about it and until it comes down to the wire. I think ultimately at the moment, markets are viewing it as largely a political risk, and markets are notoriously bad at pricing political risk until it's staring them in the face. And so now that we're kind of seeing or getting more hints of that kind of brinksmanship that's starting to come through when it comes to the debt ceiling, it's probably something that will start to come on the market's radar, especially once we get to that June deadline that Janet Yellen has laid out as kind of the first test of market sentiment around the debt ceiling. But, you know, this is a drama that markets have seen before. They're kind of conditioned to not really pay much attention to it until it's very, very imminent and it becoming kind of a front and center sort of issue.
Christine, thank you so much. Christina Aquino, our markets managing editor. Now, coming up, JP Morgan boss Jamie Dimon says the banking crisis is almost over. That's as the largest U.S. lender takes over First Republic Bank. So we'll get all of the details next. And this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
From our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. 11 minutes into the European trading day. For the moment, we're holding on to gains, not huge gains, but gains nonetheless. We have a lot of earnings that we need to get through. And then, of course, we have data from the Eurozone ahead of the ECB. Now, HSBC shares rising after the lender said it would buy back as much as $2 billion of stock as it reported its first quarter results that smashed estimates. The chief executive, Noel Quinn, spoke to Mas Cranny on his outlook for the bank for the rest of the year.
The strategy is working. I'm really pleased that we've reinstalled the quarterly dividends. So we've announced today a quarterly dividend of 10 cents per share. That's the same level that we had pre-COVID. I'm pleased with that. And at the same time, we've also been able to announce a $2 billion buyback. I think the business is well positioned going forward for sustainable profits, sustainable returns, and an ability to generate a lot of capital that can be returned to shareholders via dividend and via buyback. I think that's the most important thing I'm focused on for all of our shareholders, including Ping An.
The $2 billion buyback that we see today, is that step one of a material series of buybacks?
Well, I think we were originally planning a buyback in the second half of the year, but because of the positive business performance we've evidenced in Q1, we were able to pull that forward to Q1. I think what I think we see going forward is continued sustainable profits, and therefore the potential for a series of buybacks. We've always said that buybacks have a place, and they have a place alongside dividends to distribute excess capital. We want to retain sufficient capital to continue to grow the business. But based on what we're seeing at the moment, we think we have the potential for a series of capital distributions via dividend and buyback over the coming years.
You said when we took the pre-tax and stripped out the exceptional items that you were happy that this wasn't all interest business. But of course, we want to get your sense whether we are at peak interest flow for you. The Fed will meet this week, the ECB and the Bank of England. Do you think you're at peak net interest for 2023? The guidance remains steady.
I think we've had a good NII performance in Q1, but I think it's fair to say we've always said that 2023 will probably be the year that NII tops out because purely through rates. NII can continue to grow through underlying growth in the balance sheet and economic activity. But from the rates benefit, we always said 23 will probably be the peak year from a rates benefit point of view. And I think that still holds true. As you go up the rate curve, you get the law of diminishing returns kicking in on how much of those rate benefits you can hold on to versus the competitive pressure.
So if the bank is cranking on gas, the strategy is working, the buyback is in place. I listened to Goldman Sachs. I come in overnight, Morgan Stanley are cutting jobs. Jane Fraser said she's ready to adjust headcount. I think your previous CFO said the only thing he worried about was costs and whether you went to bed happy at night with costs under control. Are you ready to take headcount out of the business again? I mean, it's a tough subject, Noel. Are you actively considering scaling back any of the areas? Are you ready to cut headcount in investment banking, Noel?
Manus, we've taken a significant amount of cost out of the bank over the last 3.5 years. That's what we've been very focused on in our transformation program. Our Q1 cost performance at a reported level, our costs were down around about 2%. If you adjust on a sort of a constant currency and a target basis, we were up around about 2% against a target of 3%. So our costs are well controlled. This is now embedded as a day-to-day BAU cost discipline in the organization, and that's after 3.5 years of strong focus on cost. The other thing I'll draw your attention to, Manus, in Q1, most of that cost growth in Q1 against target was all technology spend. It was digitization of the bank. So that's good spend, not bad spend.
Okay, that, of course, was the HSBC CEO, Noel Quinn, there speaking to us exclusively a little earlier about good spend versus bad spend. The stock currently up close to 4%. Citi analysts describing these earnings as messy but strong. Let's bring in our finance team leader for Bloomberg, of course, from EMEA, Tom Metcalf. The biggest takeaway for you then, Tom, from these HSBC results?
Yeah, I think just broadly, they're positive. It's kind of probably exactly what HSBC management were for. They can turn around and go, look, we've got a big buyback through. We kept a lid on costs and, you know, broadly positive outlook. I think for me, though, you know, Ping An's the big sort of elephant in the room. Does this really change anything? Probably not for them. They're looking for a much bigger shift in strategy. So with the AGM on Friday, I think you'll still see some real fireworks there.
Tom, talk to us a little bit about the First Republic deal. So you could either say, look, this actually puts, you know, the lost legacy of this turmoil behind us, or you could say, wow, JP Morgan now is an even bigger bank with 15% of U.S. deposits.
Yeah, exactly. Does it store up more problems in the future, for instance? I mean, look, I think from a short-term perspective, this would suggest that, you know, that banking crisis has been rumbling on in the U.S. now for a while, is sort of should be over, at least in kind of the acute phase, as it were. No surprise that, you know, the regulator picked a bank that could basically just take all of First Republic off its hands. That's pretty much why JP Morgan, won that thing. And, you know, for Jamie Dimon, you know, JP Morgan just gets bigger and bigger.
Well, meanwhile, more lines coming through in terms of trimming of headcount, and that was obviously a question that Manus put to the CEO of HSBC in that interview. But this coming from Morgan Stanley cutting 3,000 in terms of additional headcount costs. What does this mean in terms of the broader industry? Does it signal that there are further cuts to come through?
Yeah, I think so. And the most interesting thing from that story is basically that the cuts are not going to be part of Morgan Stanley's wealth management. That's sort of been secluded from that, or excluded from that. But it will obviously be hitting their trading and their banking arms. And looking at it from the outside, you've got to think the investment banking side is going to get really hard hit by these. These are big numbers. So you'd think that's where these cuts will be focused. And it's interesting to hear, both Noel Quinn and I think the Citi CEO, Jane Fraser, also coming out. And, though they're not saying anything explicit like Morgan Stanley, I think there's going to be cuts across the board.
Yeah, adjusting. That's the new word.
Yeah.
Tom, thank you so much. As ever, Tom Metcalf there with the very latest. On banks, coming up, IBM plans for a future where bots take over significant chunks of human jobs. We'll have more on that next. And this is Bloomberg.
So intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Was going to keep rate World Cup. This is a 3 as the economic picture does.
The UK is getting ready to make a decision.
Welcome back to the Open. We are 21 minutes into the European trading day. Very modest gains of about 0.1% across the European benchmark. Banks leading the way in terms of the sectors, with HSBC, of course, the catalyst. Banks up 1% as a sector. At the bottom of the list, real estate down by about the same amount, down a full percentage point. The futures in the US are currently flat. And in terms of these debt markets, you're seeing a bit of a repricing across European debt and UK debt. Yields are up as we take into account, of course, that surprise interest rate hike by the RBA and whether or not it does indeed provide a template for the Fed with their decision on Wednesday. Let's check in on some of the stocks on the move at the open. I touched in on HSBC. Of course, we had an exclusive CEO interview. Manus Cranny there speaking to Noel Quinn, and the conversation around that surprise dividend and the $2 billion share buyback. It was a very solid beat, of course, for HSBC. That stock up 4%. But as Tom Metcalf from our finance team was flagging, it's the AGM and the pressure coming through from their largest shareholder, Ping An, which will be in focus come Friday. BP down 4%. That's despite the fact they came in with a beat versus the estimates. But profits have slowed, and the share buyback of, what, 1.75 billion down from the previous quarter. So a knock there for BP, down a full 4%. Infineon gaining 2.6%. That chip and semiconductor maker in terms of what is happening there. We have Ollie Crook on the ground in Germany. He's going to give us an update on that story throughout the day. But that stock currently up 2.9%. Let's get the Bloomberg First Word News now with Sam Etienne. Sam.
Tom, President Biden has called a meeting of top congressional leaders for next week to discuss the debt limit standoff. The invitation came just hours after Treasury Secretary Janet Yellen warned the U.S. risks running out of cash as soon as early June. Since hitting the current limit of $31.4 trillion in January, the U.S. has been using special accounting measures to stave off a possible default. And anger over President Macron's pension reform spilled onto the streets of Paris yesterday, with marches across the country. The government says over 780,000 people took part in the protests, while a Labour union put the turnout at 2.3 million. Macron pushed through the plans to raise the French retirement age to 64 last month, despite widespread protests. And writers for some of the most popular US TV shows are going on strike, demanding higher pay amid rapid changes in the way people watch films and programs. The Writers Guild of America, which has more than 11,500 members, says almost 98% of those voting last month backed the walkouts. A strike in 2007 resulted in $2.1 billion lost in economic output. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine, Tom.
Sam, thank you so much. Samuel Etienne in London. Now, IBM is preparing for a future where artificial intelligence replaces a significant number of roles. The tech giant's chief executive officer says IBM expects to pause hiring for jobs impacted by AI or automation. Well, nearly 30% of roles at the company could actually be impacted. Now, for more, let's get to Bloomberg Quick Takes. Alex Webb. Alex, we were also joking around. I mean, I don't know if we were joking. We're just talking about what part of our job we'd gladly give away to AI. But are we underestimating the impact this will have in a very short amount of time?
I think so, and I think that actually it's not necessarily that we need to worry about, it's not that everybody needs to worry about their job, but they need to be thinking about how they use AI to augment or make their job easier. Because I think we're going to be seeing companies expecting productivity increases, and those who do get their head around how to use some of these new tools will be at a significant advantage over those who don't.
How much of this is actually new, Alex?
I mean, I think the things with the IBM comments, we've probably known for some time that these jobs are the ones that are vulnerable to being replaced by artificial intelligence. I think the thing that's happened is that the huge boom that we've seen over the past few months and the heightened conversation around it has given CEOs a bit more leeway to talk about it and say, well, this is going to replace jobs. That's something investors like to hear, that jobs are going to be going. Don't forget as well, IBM offers some of these products. It is something that IBM would like to be able to sell to people. So the rise in large language models over the past few months, we kind of knew this, it was buzzy and has got a lot of popular enthusiasm. The broader tools, Amazon has been doing a lot of this stuff already. It has AI making decisions about how to deploy workforces and so on. So that in itself isn't necessarily new. It's CEOs' willingness to talk about it.
Apart from these big questions, is regulation, we hear from a number of actually, participants in the space saying we should pause for 6 months until we figure out what regulation looks like.
And huge news overnight. Jeff Hinton, who is one of, if not the godfathers of AI, he was working for Google. He's a professor at the University of Toronto. He basically created, him and a few others, neural networks. That's the basis from which so much modern AI is built. He has stepped down for Google, partly so that he can talk more openly about the risks of AI. Big story in the New York Times overnight. It's hard to underestimate how big a deal that is. He is a very, very significant figure in the world of AI.
Yeah, and he says these risks are real, and he has those ethical concerns. Alex Webb, always excellent. Thank you very much from our Quick Take team on the latest developments within AI. Coming up, the Citigroup CEO thinks the First Republic purchase addresses, quote, the major source of uncertainty. We bring you that interview. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
Markets count down in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Welcome back to the Open, everyone. 30 minutes into the European trading day. Here are your top stories. Now, HSBC profit crushes estimates as the bank says it will repurchase as much as $2 billion of stock. The chief executive officer, Noel Quinn, tells Bloomberg exclusively there may be more to come.
What I think we see going forward is continued sustainable profits and therefore the potential for a series of buybacks. We've always said that buybacks have a place, and they have a place alongside dividends to distribute excess capital.
JP Morgan agrees to acquire First Republic in a government-led deal for the failed lender. The takeover comes as Morgan Stanley is said to be planning 3,000 more job cuts as deal-making slumps. And the Aussie dollar jumps after the RBA unexpectedly hikes rates. Stocks are mixed as the Fed prepares to meet, and Treasury Secretary Yellen says the U.S. risks running out of cash as soon as June the 1st. So we look at the markets, and Tom, for the moment, we're also expecting data out of the Eurozone.
Yeah, CPI, of course, coming through at around 10 a.m. UK time from the Eurozone with a particular focus on core and whether or not, for the first time, we're actually going to see a marked change lower and a tick lower for core. That will, of course, be essential for those officials at the ECB, as we've heard, of course, a string of hawkish commentary from amongst the governing body of the European Central Bank. Across your European equity benchmark, gains of 0.1%. It's a slightly more positive picture here in the UK, lifted by HSBC. The FTSE 100 gaining 0.2%. Over in Germany, the DAX just up 15 points. Let's have a look on how the sectors are shaping up. Then top of the list is banking as a sector, gaining a little over 1%. HSBC with its beat, of course, the dividend, the surprise dividend, and the buybacks of around $2 billion. Bottom of the list, energy down a full 1%. The challenges, of course, around WTI, Brent, and the broader commodities index as data out of China is pretty mixed, with a particular focus on the surprise softness coming through from manufacturing out of the world's second largest economy. Fran.
Now, Citi Chief Executive Officer Jane Fraser says the company is willing to make adjustments to staffing level at its investment bank amid the ongoing industry-wide slump in deal-making. Now, she spoke to Bloomberg on the margins of the Milken Institute Global. She also expressed her relief at the conclusion of a deal for the failed First Republic Bank.
It's always a sad day when you see a bank fail, but we are all very pleased to get the major source of uncertainty that was remaining from the recent bank turmoil addressed. And that is a good thing, because fundamentally the US financial system is sound. This is a case of a small handful of banks that were poorly managed. And getting this addressed is very important. When we stood up, I think it's a statement that the major banks, the 11 major banks in the country, in 30 hours, put $30 billion to work to buy the time to get the right solution and answer put in place. And that was our intention. It wasn't to provide the answer. It was to give the time for confidence to get restored and our regulators to do their job, which they did.
With First Republic being out of the way now, certainly that was the whale in the room, but what do you expect next in terms of any future bank failures or even hiccups down the road?
So I'm more optimistic around it. I do think the U.S. financial system is extremely strong. The large American banks globally are in an enviable position. Our financial system has a particular structure to it, the large banks, the regional banks, the commodity and community banks. Everyone plays a different role. We play different scale, different customer bases, but it's a strong system. I am anticipating there will be some more consolidation. We do have over 4,500 banks, and it's likely that the minimum efficient scale will rise, but I don't think that brings into question a system that is the envy of the world. This is a strong and highly desirable financial system.
With that
works.
said, the big just got bigger today, right? This is JP Morgan rather than regional banks consolidating among each other. Does that create more competition for the smaller banks, given that the big are getting so big in this country?
I think there's room for everyone to play their roles, and the larger banks are also playing on a global scale. When I look at our own bank, our strategy is around being the preeminent partner for clients with cross-border needs. That is a very different role from the role that a community bank plays, which is also very important in the context of the local economy. So I think it's about different banks playing different roles, and let's make sure that we have a strong and successful system that works.
There's a lot of worries about the credit contractions that could be seen in the United States, particularly among that sector, small, medium-sized banks that tend to bank small and medium-sized businesses. Do you expect that there will be a significant contraction, and how do you handicap the ripple effects to the economy?
So certainly the risks now are more to the downside than they were at the beginning of the year. And no one anticipated the turmoil that we've seen so far this year at the beginning. And I think it certainly makes the second half is not going to be as strong macroeconomically or in terms of investment banking wallet and the like that we had hoped. That said, I think, as you say, one of the big questions will be to what extent does credit tighten? And if that is material, that will have a drag on the economy. We're anticipating a recession at the back end of the year, but the amount of pent-up demand, the amount of the strength of the corporates, the strength of the consumer coming into this, the usual amplifiers of a contraction are not in place. And I think we'll see the U.S. economy, unlike others, pull out of whatever a recession environment could be pretty quickly.
Okay, the CEO of Citigroup, Jane Fraser, there. Coming up, Infineon breaks ground on a new chip factory, the biggest investment in the company's history. We are live in Dresden next, and we're going to be speaking to the CEO. That's at 10:30 a.m. UK time. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion and Flat says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. The ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
Are we underpricing here in Europe, and just how far the ECB could still go?
We really haven't seen an impact from the hiking cycle on inflation yet.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference. Coverage begins Thursday on Bloomberg, your global business authority.
Welcome back to the Open. We are 40 minutes into the European trading day, flat across the European benchmark, but there's activity in the banking sector, top of the list in terms of the gains, supported by a very solid beat coming through from HSBC. In terms of your debt markets, yields are ticking up across European debt and UK gilts as well, following that RBA surprise hike of 25 basis points. We look ahead to the Fed on Wednesday, of course, and then whether or not the banking turmoil in the US has really been put to bed with that takeover of First Republic by JP Morgan. In the US, futures pointing to very modest gains on the NASDAQ futures. S&P E-minis, though, are flat. Now, fresh inflation data from the euro area this morning will be keenly watched, of course, ahead of the ECB's monetary policy decision on Thursday. The ECB has pledged to be data-driven and focus on core inflation dynamics in its most aggressive hiking cycle to date. To preview, we go to our European correspondent, Maria Tadeo, in Brussels. Maria, new data out later then. What are we expecting?
And Tom, this is a number everyone in markets is paying attention to because of the significance and the implications that it will carry in the monetary policy decision on the Thursday. And obviously, Tom, you know there's two numbers to watch out for. Is the headline inflation, which, by the way, when you look at the median estimate that we have on the Bloomberg terminal, it would show that inflation in April was essentially the same as a month prior at 6.9%. But then, of course, there's a core inflation dynamics. If you look at that median estimate that we have running on the terminal, it would come in at 5.6%, which is just a touch lower than the previous month. But, you know, this is really the big number that the European Central Bank watches out for. They've said now repeatedly they will now be data-dependent, mega data-dependent, I would say, meeting by meeting, and also focusing very much on that core inflation and the transmission dynamics that are going on. This number, again, all data matters, but the one that will be hitting the wire in hours from now, this is a crucial one going into Thursday.
So, Maria, what are the implications for the European Central Bank, depending on what kind of data we get?
Absolutely. And Francine, remember, from now on, they have said it really is the data, and they come in with those numbers in mind. There is no forward guidance essentially going on into meetings. From meetings, it really comes down pegged to the data also coming very hot into the meeting. Essentially, there's a 24-hour lag. Now, Francine, the question is, by now it's pretty much understood that on Thursday they will hike again. Will it be 25 basis points or 50 basis points? There's a note by Deutsche Bank today, which I received, essentially suggesting there's arguments for both. They see a 25 basis points hike on Thursday, but also say they view this as a very close call going into the meeting, and 50 basis points before downshifting majorly potentially in June could not be or should not be ruled out.
Maria, thanks so much. Bloomberg's European correspondent Maria Tadeo there in Brussels. Now let's get straight to the Bloomberg Business Flash. Here's Samuel Etienne. Hi, Sam.
Morning, Francine. Tech giant IBM says it will pause hiring for back office roles it thinks could be replaced with AI in the coming years. Of 26,000 non-customer facing roles, CEO Arvind Krishna says 30% could be covered by AI and automation in the next 5 years. IBM currently employs about 250,000 staff worldwide. And Qantas Airways has named Vanessa Hudson as its next CEO, making her the first woman to lead the airline in its more than 100-year history. Currently CFO, she'll take the top job in November, inheriting an airline delivering record profits, but also facing strained relations with customers and unions.
We are in an incredibly strong position. We've got many things in the pipeline. That's not to say that the past 3 years haven't been challenging. They have, and there will be many challenges, I'm sure, ahead. But my focus when I step into the role in November is going to be focused on delivering for our customers, delivering for our people, and also our shareholders and the communities.
And Bloomberg has learned that Morgan Stanley plans to cut 3,000 more jobs amid a deal-making slump. The banking and trading group is expected to shoulder many of the reductions. CEO James Gorman said last month underwriting and mergers activity had been subdued. It's the American bank's second round of job cuts within 6 months. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Tom, Francine.
Sam Etienne here in London. Thank you. Now, the EU is aiming to produce 20% of the world's chips. Right now, it makes about 10%. Today, Infineon breaks ground on a new chip factory in Dresden. It's the biggest investment in the company's history. Let's bring in Bloomberg's Oliver Crook, who's on the ground for us. Ollie, what then is the significance of this project?
Right, Tom, so this is all about strategic autonomy, digital sovereignty, things we hear a lot about from Ursula von der Leyen, the EU Commission, from Schultz, and they are both arriving here today, which really underscores the importance of this project. So a big ado about a very little thing. These chips here that are essential to everything that goes into the future of the economy, goes into cars, goes into wind turbines, really sits at the center of the future of kind of the entire economy in both major industrial stories. So Infineon will break ground today on this project. They have already 3 fabs here. This will be the 4th of them, and this is to create the kinds of chips that go into all of these things that we're talking about, wind turbines. They're going to put 5 billion euros in. The German government is expected to match that with another billion euros, but really this is, for them, the reality of this project. So we talk a lot about it, but this assembly line, which will be operational in 2026, to double that supply is a huge undertaking for Europe.
So, Ollie, the EU, of course, wants to more than double their chip output. Is that even possible?
Well, this is a very good question. So the thing is that you have to look at all the factors that are going into this. You have the political will, you have Schultz, you have von der Leyen, they're arriving here. You have the EU Chips Act, about 50 billion euros worth of support to this. But then you have a lot of other unanswered questions. And when we talk to the CEO a little bit later, we'll try to get our heads around this a little bit. Do they have, for example, the very, very skilled labor that's required to produce these chips? This is going to create 1,000 jobs here in Dresden. These are highly sophisticated jobs. Do they have the expertise to fill those jobs? You have also this question of, with similar to the Inflation Reduction Act, we have all these governments supporting this industry. Are you at risk of going to sort of a race to the bottom for chip manufacturing and really overpaying for what is going to be extremely costly? And also you have this issue with China. Obviously the US trying to block this technology from going into China. Could that create all kinds of other supply chain issues that we've heard throughout? I will say one thing to leave you with this, that Saxony here, they call it Silicon Saxony. We've heard Silicon Valley. Silicon Saxony, and it may sound sort of funny, but really 1/3 of chips that are produced in Europe right now are produced right here in Saxony.
There you go. News that you can use that we did not know. Ollie, thanks so much, Oliver Crook there in Dresden. Now we'll hear from Infineon's chief executive a little bit later. That interview, 10:40 a.m. London time. Coming up, debt deadline. U.S. President Biden sets a high-stakes debt limit meeting as the deadline nears. We'll bring you the latest next, and this is Bloomberg.
expensive cities have a lot going for them. But if you live in one, you've probably noticed that these big, expensive cities keep getting more, well, expensive. You could always move away. You might have just started working remotely, so there's really nothing keeping you there. But then again, moving is a hassle. Well, what if someone paid you 10 grand to do it? What if they threw in free office space, a bicycle, or a gym membership? Programs in cities and states around the US are doing exactly that, and they're getting a lot of interest.
We've had over 50,000 applications.
About 90,000 applications.
We've had over 1,800 applicants from all over North America.
So are these nascent programs actually beneficial to their communities and the workers joining them? Or are they little more than flashy advertising campaigns for places looking for an injection of fresh talent?
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Chairman Powell has been, and we need him to stay resolute on inflation. We're anticipating higher than the market would like for longer than the market would like.
We think that they will hike. They'll still probably leave room for potential discussion around further rate hikes well before any kind of rate cuts.
I think there's a push-pull. I think the direction of travel Wednesday is going to be up.
Our expectation is rates. We have one more hike here, and then we'll be on pause as the Fed watches the data come through.
It would seem to us that we're going to start to experience a significant economic slowdown starting mid-year.
Many of us here at Milken do believe that there is that, the market is too enthusiastic here, partly because the economy is so resilient.
Okay, Bloomberg TV guests, of course, at the Milken Institute Global on tomorrow's Fed rate decision. Checking in on these markets. Welcome back, by the way, to the open. 51 minutes into your trading session. Flat across the European benchmark. Futures also flat in the US. A lack of direction, maybe just money being held in situ before that decision from the Federal Reserve as markets expect that 25 basis points. But the surprise coming through from the RBA, the Aussie surprise, may be leading to a rethinking of just how hawkish these central banks will and can be. Yields up on European debt. The currency in focus, of course, is the Aussie dollar, running higher on the back of that surprise increase. Currently, the Bloomberg Dollar Index is down about 0.1%. And in the movement across these equity markets, it's being really pronounced in banks at the top end, energy at the bottom end. Energy as a sector down 1.3%. Of banks gaining 1%. HSBC with a surprise dividend and the share buyback of around $2 billion. Fran.
Now let's take a look at some of the events that we're following throughout the week, and there are many today. 10 a.m. UK time, we'll have Euro area CPI, followed by the latest U.S. jobs employment data. Tomorrow we get U.S. ISM services, and then the Fed's rate decision. That's followed by the ECB's rate decision on Thursday, and U.S. initial jobless claims. Finally, on Friday, U.S. unemployment and non-farm payrolls.
Okay, President Biden, meanwhile, has called top congressional leaders, inviting them to a May the 9th meeting to discuss the debt limit standoff. It's a sign of the growing fears of a default, as the federal government might be unable to pay its bills as soon as June the 1st. That coming through, of course, from the US Treasury Secretary. Let's get the details then on how things stand with Bloomberg's Bruce Einhorn. Bruce, where are we then? Is this a concession from the US president to the Republicans? Is there any sign there's movement on the debt limit?
Well, the U.S. breached the debt limit initially back in January. Treasury has been using what they call special accounting measures, maneuvers to avoid the actual default. And most people were expecting that this would be something that would be an issue that would come to a the top at sometime in the summertime, maybe into the fall. But now it turns out, according to Janet Yellen yesterday, that actually the deadline may be a lot sooner. Maybe the beginning of June. Congressional Budget Office yesterday came out with a similar assessment saying that it could be June. So not even summer, we're still in springtime in the US, and it will already be time. So the president has called for a meeting with congressional leaders, including Speaker McCarthy. That would be next week. One big complication here is that there's not a lot of time left. Both houses of Congress will be going on recess for a week later this month. The president's going to be traveling to Japan for the G7, to Australia. So there's not a lot of time where everybody's in Washington where they could all sit down together and discuss how this is all going to play out.
Bruce, how different is this going to be from past debt ceilings? I don't know whether it's going to be more difficult to find an agreement and whether markets should really start, pricing in something bad happening, or whether that's just off limits.
Well, there is the expectation that eventually things will work out, but there are big differences. So from the Democrat side, President Biden and many others in the White House and in the Democrat Party, they've taken the lesson from 2011 when President Obama negotiated with Republicans over the debt ceiling. And the lesson they took from that is, no, we don't allow hostage taking when it comes to the debt ceiling. There has to be a clean debt ceiling. We'll negotiate over the budget. On the Republican side, you have Kevin McCarthy with a very slim majority in the House. He barely won the speakership. So he has very little room to maneuver, and quite a lot of members in his caucus really feel like this is something that they want to go to the mat on. So the circumstances have changed from last time. One thing to be thinking about is whether in the end you would have President Biden do something that in the past, say, President Obama refused to do, said it wasn't in his power, do something like say that according to the 14th Amendment, this whole thing is unconstitutional, or there's always the possibility of the Treasury Department issuing some $1 trillion coin or something like that. These are things that are out there that people have dismissed as outlandish, but as we get closer and closer to the deadline, those might be things that people really do talk about as
all right. The prospects of the $1 trillion coin. Bruce, very briefly, the business community of the US, where have they landed on this?
Well, I think that a lot of people have been hoping that this is a problem that will just take care of itself, right? But I think the message from Janet Yellen will focus a lot of people's minds that this is something that is much more of a pressing problem that has to be dealt with now, rather than just hoping that it'll take care of itself a few weeks, a few months from now.
Bruce, thanks so much. Bruce Einhorn there on the debt ceiling. Well, that's it for the European Market Open. Surveillance Early Edition is up next. We'll have a full roundup of economic data out of the Eurozone that, of course, will impact what the ECB decides, or certainly how they will explain inflation will perform. And then we'll have a full roundup of earnings, especially banks. This is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding, and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear, and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Good morning. This is Bloomberg Surveillance. Welcome to Bloomberg Markets, trying to open.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
This is Bloomberg.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. HSBC shares rally after the bank crushes estimates and says it will repurchase as much as $2 billion of stock, while the chief executive officer, Noel Quinn, tells Manus Cranny exclusively there may be more to come. JP Morgan agrees to acquire First Republic in a government-led deal for the failed lender. The takeover comes as Morgan Stanley is said to be planning 3,000 more job cuts as deal-making slumps. And the Aussie dollar jumps after the RBA unexpectedly hikes rates. Stocks are mixed as the Fed prepares to meet. And Treasury Secretary Janet Yellen says the U.S. risks running out of cash as soon as June the 1st. Now, we're just getting some breaking news. We have quite a lot of data. April manufacturing data, PMI coming in at 45.8. That's a touch above expectations, but also the ECB is saying that banks have tightened their credit standards more than expected in the first quarter. Now, this is an extremely important data point because this is the first time that we really hear from what happened in March. So we have manufacturing PMI for the month of April for the euro area. That's a touch better than expected. Now, what that means for ECB going forward, look, the ECB is saying that euro area banks have curbed credit by more than expected, could really weigh on its thinking. It could also slow the pace of its interest rate hikes. So let's get a look, or let's have a look at what a lot of these markets overall are doing. The other story we're watching out for is, of course, HSBC and a lot of the banking story. HSBC, for example, predicting its wealth revenue recovery will continue. So this is a picture across the board. We started the day higher when it came to European stocks. It's now down 0.3%. S&P futures also slightly lower, and then Aussie dollar 66.95 after we heard from the RBA. So HSBC shares, if we get onto the banks, HSBC shares are rallying after the lender beat first quarter estimates and announced a $2 billion buyback. The chief executive officer, Noel Quinn, also commented on the global impact of the U.S. banking turmoil. Well, he spoke exclusively to Bloomberg.
I'm really pleased with the transaction that took place over the weekend. That helps to stabilize the regional banks in the U.S. So I do think these are challenges as we go from one era to another, but I don't believe we're anywhere close, or it's not going to become a systemic issue globally.
Well, joining us now is Bloomberg's finance team leader for EMEA. He is Tom Metcalf. So, Tom, good morning. Again, HSBC, I mean, stellar results. What were the main takeaways?
Yeah, you can look at those shares shooting up. I think just across the board, it's probably a set of results management are very happy with. For me, it's that buyback that's probably most pleasing shareholders. But ultimately, you know, the big story about HSBC is with its top shareholder, Ping An, right? And these set results, good as they may be, doesn't necessarily resolve anything there. And you've got the AGM on Friday. So I think the big story this week will still be what happens then.
Okay, so what happens then is also a question that we need to ask ourselves after the March term. Also, with the First Republic deal, I don't know whether we focus on JP Morgan saying now it's such a huge bank, or whether with First Republic, at least it takes care of the lost problem child.
Yeah, well, clearly regulators made the call. It's better to have JP Morgan grow even bigger and basically be able to take First Republic off effectively regulators' hands. So that's kind of why JP Morgan won it. They were able to go in and just say, we will take all these deposits, all these loans, and basically allow business to continue as usual. Other bids, we understand, were a bit more kind of reliant on regulator help. So that's why that decision was reached. But yes, the big question now is, JP Morgan's bigger than ever. What does that mean, for the wider US financial system?
And then we have cuts at Morgan Stanley, and that could be 3,000. What did it tell us about investment banking this year? Yeah,
that is the area that's probably got to be most concerned by this. Morgan Stanley have come out and effectively saying, we're not going to be cutting wealth management, we'll be cutting banking and trading. Trading's still doing pretty well, so I would say most of the cuts are going to go through those deal makers, those rainmakers. So until that deal flow improves, it's going to be tough times at Morgan Stanley, but also we're seeing this at other banks as well, like Citi, even HSBC today saying they're sort of monitoring the situation. So I expect a lot more job cuts to come, I think, in investment banking.
Tom, thank you so much. Tom Metcalf there, who's, of course, in charge, our finance team leader for EMEA. Now, ahead of the ECB's policy decision this Thursday, investors will be keeping a close eye on the data for clues on the rate path. Last to the bunch, or in the bunch to report Euro area and Italy preliminary inflation figures for April are out at 10 a.m. UK time. Well, joining us now is Nandini Ramakrishnan, EM Equity Macro Strategist at JP Morgan. Nandini, as always, thanks so much for joining us. So we just had a couple of data points from, the Euro area saying, for example, Euro area banks have curbed credit by more than expected. If you look at central banks, are they looking at the credit crunch and worrying about it, or do they still have to just nip inflation?
No, I think absolutely. Mandate of a central bank is obviously one thing is defined on paper, but seeing what happens with the real economy, financing conditions is going to be extremely important for the ECB, for the Fed this month as well, because financing conditions are tightening, and that's going to be one of the more leading indicators rather than, let's say, unemployment or labor market, which are more lagging indicators in the economic cycle. So certainly, absolutely looking at financing conditions and investment objectives from corporates and investment sentiment from corporates, because that's what kind of drives the next few months or next few quarters of economic growth.
So what are you expecting overall from, a lot of the central banks? I'm thinking of the ECB and the Fed, and how does translate into emerging markets?
Definitely. I think that this month is going to be, if not the last, but one of the last hikes for both the ECB and the Fed. I think they're going to be cautious about indicating any more hawkishness because of what's been happening both globally in the macro data, as well as some of the financial stresses we've seen over the past few months. So I think we're nearing to those peak interest rate points. And actually, this is boding well for emerging markets who traditionally have been a bit more challenged when DM central banks are hiking. But actually, when we've got this clear messaging of nearing the peak in DM, EM central banks actually have space to potentially even cut. We've heard from a few that they're pausing, so cutting would be even more beneficial for EM macro overall.
I mean, that has huge implications for the dollar. First of all, we're getting a bit of movement on the European bond yields with the ECB. Once again, that headline crossing the Bloomberg terminal just moments ago saying that banks have tightened their credit standards more than expected in the first quarter. So does it play, the more we see movements in this, how do you play it through emerging markets?
Well, the dollar is a huge sentiment indicator as well as a good temperature check for emerging markets as a whole. And the dollar, which was in our measures 25% above fair value in October last year, is now just 3 to 4% above fair value. So that huge drop in the dollar is going to provide a big boost to emerging markets, both from a global trade perspective, but also simply from sentiment, from the fact that EM economies can now import more, their currencies are stronger. So we do feel very positive that that dollar shift is going to play out this year, especially as we get messaging from DM central banks about peaks.
Nandini, so we also have, quite a lot of talk about China's reopening being well underway. And then what struck me is two speeches from Christine Lagarde and Janet Yellen talking about fragmentation. How do you model that actually? Are we underestimating the impact this could have globally?
Look, I think China is very clearly on its own cycle versus the rest of the world on an economic basis. So reopening is well underway. We're seeing data ticking up, EM earnings, especially China earnings, ticking up, while DM earnings are starting to feel a bit of that financial conditions tightening or peak interest rates. So there is a bit of economic fragmentation. But of course, there's also, we must look at geopolitics. And though that is a challenge for sometimes EM investors, it's part of the long-term story. And we do model that in terms of risk frameworks or thinking about cost of equity or various other measures we can input into our models to make sure that we're capturing kind of global landscape accurately.
Do you worry about the freezing, actually, of, I don't know whether the banking crisis is over, but, liquidity freeze out there in the markets that could seize up? If, for example, we were to see something with the debt ceiling, that would also translate to emerging markets.
Well, I think broadly, money supply globally has been higher than it's really ever been in an aggregate volume terms. So I don't worry about a huge liquidity seizing. We see that most pricing in terms of equity markets and bond markets are pretty sanguine about various slowdowns. They do seem to have quite a bit of trading volume across the world. So I wouldn't say we're worried about a liquidity issue. Also specifically on debt ceiling and some of the other concerns, though the downsides are potentially very big, there's usually been a resolution, and we don't expect this to be a huge market mover, maybe a bit of volatility and headline noise around the major events. But overall, this year does seem to be a year where we think that the biggest surprises are hopefully over.
And Nandini, is there something that we're underestimating? I don't know whether there are structural reforms in certain parts of EM, and therefore you look at country specific, or whether it's just the fact that AI, we don't know where AI ends up, right? And that has implications for the models you're looking at.
Yeah, I mean, there's always going to be new technology and new parts of the market that we may not know exactly how they're going to play out. But overall, it does seem like while the past few years have been dominated by the pandemic, risks of higher inflation last year, this year feels like a more traditional kind of garden variety central bank-induced slowdown in DM and a big reopening play for China in EM, which should be supportive of the global ex-DM space over 2023.
How do you play geopolitics? I mean, this is the nightmare, right, for any kind of bank strategist to get to grips with.
Yeah, I think the major thing is thinking about where the economic relationships lie. Yeah. And when you hear headlines of certain geopolitics, of course, that's going to be alarming. But if you think about the trade flow between emerging markets and the rest of the world, that has increased. Globalization actually on much of the data hasn't decreased, right? There's still goods moving around. The demand for goods globally is voracious, and EM is a big supplier of that, both raw and manufactured goods. So I do still think keeping an eye on the actual data rather than the headlines is the best way to play this as a global investor.
Thank you, as always, such smart insight. Nandini Ramakrishnan, their EM equity macro strategist at JP Morgan. Coming up, IBM plans for a future where bots will take over a significant number of human jobs. We'll have more on that next, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Business Week Radio. Live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, IBM is preparing for a future where artificial intelligence replaces a significant number of roles. The chief executive officer expects to pause hiring for jobs impacted by AI or automation. Well, that could account for as many as 30% of roles. Well, joining us now is Bloomberg Quick Takes Alex Webb. Alex, good morning again. So if you look at some of the comments, what are you expecting actually the impact of AI to be?
I think it's true that a huge number of jobs are going to be vulnerable to artificial intelligence. I think the interesting thing is that when people talked about automation 10 years ago, they were very much thinking about factories, that repetitive manual labor jobs were the ones that are going to be replaced by robots. Now we're starting to see that, well, robots are huge capital expenditure. AI, as we're seeing it right now, is software. It is sort of infinitely replicable, so therefore it's the more repetitive, often sometimes creative jobs that can be done by a large language model, at least partially, those are starting to become a little bit more vulnerable.
So how much of this is actually new?
I think if you look particularly at IBM and the sort of positions they're talking about, which is, you know, as they say, back office functions, some human resource positions, they probably could have said that a little while ago. Amazon already does some human resources stuff with AI, where it looks at sort of performance in some of their warehouses, and you see people, Bloomberg had a great story on this last year, literally being fired by a bot, right? So this is something that is already happening. I think the new thing now is that CEOs are way more willing to talk about it, because everybody wants to be saying, AI, we're using AI, it's changing our business, that's great, isn't it? And it's like, well, it's good, but not necessarily if you're someone in one of those jobs.
But Alex, so the pace of change, right, could also be widely faster because of the processors than we thought even 6 months ago.
Yes, I think, look, the pace of change is largely to do with the fact that OpenAI released this product as a beta.
So it changes things.
Everybody went, oh gosh, we really need to hurry up, right?
Right.
I think in terms of the processor power, like this stuff is already going into deployment. We're seeing Microsoft talk about now expanding CapEx so that it can add more AI processing power to its data centers. That, I think, though, that is not the tail wagging the dog. That is, you know, literally, they're seeing the demand for AI, therefore they're expanding their capacity. The differentiation here is that this is going to be, for a lot of companies, a cloud product. If you want to be using these AI tools, you probably need to be using Google Cloud or Microsoft Azure. Therefore, its salespeople are going to be pushing it because they see it as a way of stealing share from Amazon Web Services.
Alex, and there's an article actually that you pointed to me this morning, which is basically, you know, just a growing number of people that really understand AI that are worried about what it becomes.
Yeah, so Jeffrey Hinton, who is a professor of AI essentially at the University of Toronto and is considered a godfather of AI. He designed neural networks, was one of the key people behind that innovation, which in itself has driven this new generation of AI that we've seen. He also had a contract working for Google. He's stepped back from that role, partially because he wanted to be able to talk more freely about some of the dangers and is slightly scared by the pace of the change.
Alex, as always, thank you so much. Our Bloomberg Quick Takes, Alex Webb on technology. Coming up, Infineon breaks ground on a new chip factory, the biggest investment in the company's history. So we're live in Dresden next, and this is Bloomberg. you're so intimately linked to the future of the UK, what are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacroix here in London. Now let's get straight to the Bloomberg First Word News with Samuel Etienne. Hi, Sam.
Morning, Francine. President Biden has called a meeting of top congressional leaders for next week to discuss the debt limit standoff. The invitation came just hours after Treasury Secretary Janet Yellen warned the U.S. risks running out of cash as soon as early June. Since hitting the current limit of $31.4 trillion in January, the U.S. has been using special accounting measures to stave off a possible default. And anger over President Macron's pension reform spilled onto the streets of Paris yesterday, with marches across the country. The government says over 780,000 people took part in protests, while a labor union put the turnout at 2.3 million. Macron pushed through with plans to raise the French retirement age to 64 last month, despite widespread protests. And the U.S. says Russia has suffered more than 100,000 casualties, including 20,000 deaths, in the bloody standoff over Bakhmut in eastern Ukraine. The commander of Ukraine's ground forces says Russian troops have been pushed back from some positions in the region, which has seen intense fighting since December. And writers of some of the most popular U.S. TV shows are going on strike, demanding higher pay amid rapid changes in the way in which people watch films and programs. The Writers Guild of America, which has more than 11,500 members, says almost 98% of those voting last month backed the walkouts. A strike in 2007 resulted in a $2.1 billion loss in economic output. That's global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Samuel Etienne, and this is Bloomberg. Francine.
Sam, thank you so much. Now, the EU is aiming to produce 20% of the world's chips. Right now, it makes about 10%. Today, Infineon breaks ground on a new chip factory in Dresden, the biggest investment in the company's history. Well, joining us now is Bloomberg's Oliver Crook. Ollie, good morning. So how significant is this project?
So, Francine, we talk a lot about digital sovereignty. We talk about strategic autonomy and all these sort of things. And this is the reality of that. This is literally what needs to happen to get it done. And so Schultz and von der Leyen are coming here to inaugurate this groundbreaking. So a lot of fanfare, a lot of big commotion for a very little thing. These chips that go into everything that we use, everything from our cars. In Germany, obviously, that is one of the main focuses. The average car has 1,400 chips in it. And so here, Infineon has already got 3 fabs. They're already building. Now this is the fourth. Saxony, this region of Germany, so we talk about Silicon Valley, London is tried with the sort of Silicon roundabout. Silicon Saxony actually produces 1/3 of all of the chips that Europe that creates. And really, they want to double their capacity. They want to do 20% of the world's chips within Europe, and that is an absolutely monumental task. And these are the kinds of chips that go into not just the EVs, but also into the wind turbines. So it's at the center of these two major industrial stories in Germany, digitization and the energy transition. Without this, you have no future.
So the EU wants to more than double their chip output. I mean, this seems so hard to do, Ollie. Is that even possible?
That's right, and that's why von der Leyen is here. Scholz is going to be coming here, and really, this is what we're going to talk to the CEO about in just a few minutes. Can Europe actually achieve this? The political will is there. Some of the money is there. The EU Chips Act, 43 billion euros going into it. But you run into some of the same risks that you have with the Inflation Reduction Act. Will you have a race to the bottom with the U.S. and everybody trying to attract all these companies? Germany is still trying to bring TSMC and Intel here, putting up billions of euros of subsidies. And then you have the question of jobs. Do you have the skilled labor to bring all of this stuff to fruition? This will create 1,000 jobs here in Dresden, but do you have the technical capacities? And with that, on the back burner, you have the simmer of this sort of tech war between China and the United States, U.S. putting up barriers for China to be able to produce these sort of advanced semiconductors. Could that have a knock-on effects and really dent the chip industry going forward?
Ollie, thanks so much. Oliver Crook there with the very latest from Dresden on chips. Now, we'll also hear from the Infineon's chief executive a little bit later on that interview, 10:40 a.m. London time. Now, the ECB has said that euro area banks have curbed credit by more than expected. Credit standards have tightened further substantially in the first quarter. That's according to the ECB's bank lending survey. The decline in net demand from firms was actually more than foreseen by the banks in the previous 3 months. And again, this is extremely important. It is moving German bond yields because the poll is also the first to offer some pretty concrete indications about the knock-on effects of Silicon Valley's March demise and Credit Suisse takeover by UBS a little bit later on. Now, what that means is that the tighter lending conditions were also driven by banks' perception and tolerance of risk, while the ECB's rate increases also played a role. That's according to the report. We'll have a look at what that means for whether they need to update their call on 25 basis points. Certainly, I know Bloomberg Economics is looking at this composite indicator to see whether anything changes going forward. Let's also look at the banks. We have quite a lot of bank news. Not only is the bank news about HSBC with some pretty stellar performance, the banks also in focus after the Citi chief executive said she's willing to adjust staffing levels in the investment bank. And coming up, HSBC announced that it would buy back as much as $2 billion of stock. This is Bloomberg.
Solar energy, wind power, battery-operated cars. The transition from old to new energy forms has investors placing bets on which technologies will come out on top. Bruce Flatt's Brookfield Asset Management sees what it calls massive opportunities. Its new impact fund raised more than $15 billion, and Flatt says it could have raised more. The fund has two targets: companies that need to dramatically curb greenhouse gas emissions, like power providers, and those that are in a position to dominate in clean energy. Brookfield hired former Bank of England Governor Mark Carney to strengthen its environmental, social, and governance investing. In March, Australian utility AGL Energy shot down Brookfield's takeover offer. The firm had aimed to accelerate AGL's transition to net zero emissions by over a decade. Carney signaled that this was no problem. He says Brookfield is reviewing at least 50 potential transactions across a range of industries.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Banks in the Eurozone curbed lending more than anticipated after borrowing costs jumped amid the banking turmoil, reinforcing calls for the ECB to slow the pace of its interest rate hikes. HSBC shares rally after the bank crushes estimates and says it will repurchase as much as $2 billion of stock. Well, the Chief Executive Officer, Noel Quinn, tells Bloomberg exclusively there may be more to come. And JP Morgan agrees to acquire First Republic in a government-led deal for the failed lender. The takeover comes as Morgan Stanley is said to be planning 3,000 more job cuts as deal-making slumps. HSBC shares rising after the lender said it would buy back as much as $2 billion of stock as it reported first quarter results that smashed estimates. Well, the Chief Executive Officer, Noel Quinn, spoke to us exclusively on his outlook for the bank for the rest of the year.
The strategy is working. I'm really pleased that we've reinstalled the quarterly dividends. So we've announced today a quarterly dividend of 10 cents per share. That's the same level that we had pre-COVID. I'm pleased with that. And at the same time, we've also been able to announce a $2 billion buyback. I think the business is well positioned going forward for sustainable profits, sustainable returns, and an ability to generate a lot of capital that can be returned to shareholders via dividend and via buyback. I think that's the most important thing I'm focused on for all of our shareholders, including Ping An.
The $2 billion buyback that we see today, is that step one of a material series of buybacks?
Well, I think we were originally planning a buyback in the second half of the year, but because of the positive business performance we've evidenced in Q1, we were able to pull that forward to Q1. I think what I think we see going forward is continued sustainable profits, and therefore the potential for a series of buybacks. We've always said that buybacks have a place, and they have a place alongside dividends to distribute excess capital. We want to retain sufficient capital to continue to grow the business, but based on what we're seeing at the moment, we think we have the potential for a series of capital distributions via dividend and buyback over the coming years.
You said when we took the pre-tax and stripped out the exceptional items that you were happy that this wasn't all interest business, but of course we want to get your sense whether we are at peak interest flow for you. The Fed will meet this week, the ECB and the Bank of England. Do you think you're at peak net interest for 2023? The guidance remains steady.
I think we've had a good NII performance in Q1, but I think it's fair to say we've always said that 2023 will probably be the year that NII tops out because purely through rates. NII can continue to grow through underlying growth in the balance sheet and economic activity, but from the rates benefit, we always said 23 will probably be the peak year from a rates benefit point of view, and I think that still holds true. As you go up the rate curve, you get the law of diminishing returns kicking in on how much of those rate benefits you can hold on to versus the competitive pressure.
So if the bank is cranking on gas, the strategy is working, the buyback is in place. I listened to Goldman Sachs. I come in overnight, Morgan Stanley are cutting jobs. Jane Fraser said she's ready to adjust headcount. I think your previous CFO said the only thing he worried about was costs and whether you went to bed happy at night with costs under control. Are you ready to take headcount out of the business again? I mean, it's a tough subject, Noel. Are you actively considering scaling back any of the areas? Are you ready to cut headcount in investment banking, Noel?
Manus, we've taken a significant amount of cost out of the bank over the last 3.5 years. That's what we've been very focused on in our transformation program. Our Q1 cost performance at a reported level, our costs were down around about 2%. If you adjust on a sort of a constant currency and a target basis, we were up around about 2% against a target of 3%. So our costs are well controlled. This is now embedded as a day-to-day BAU cost discipline in the organization, and that's after 3.5 years of strong focus on cost. Okay. The other thing I'll draw your attention to, Manus, in Q1, most of that cost growth in Q1 against target was all technology spend. It was digitization of the bank. So that's good spend, not bad spend.
Well, that was the HSBC Chief Executive Noel Quinn speaking to our Manus Cranny a little bit earlier today. Now, First Republic Bank is officially dead. The country's largest bank by assets, JP Morgan outbid at least 3 others in a government-led deal for the failed lender. Bloomberg's Scarlett Fu has the details.
JP Morgan's Jamie Dimon knows a thing or two about buying troubled banks. 15 years after his firm took over Washington Mutual and Bear Stearns, JP Morgan won a government-led auction to acquire First Republic Bank. It's a deal that makes JP Morgan, already the largest U.S. bank, even larger, while also minimizing damage to the FDIC's fund that guarantees all bank deposits under $250,000. As part of the agreement, JP Morgan and the FDIC will share the burden of losses and any recoveries on First Republic's mortgages and commercial loans. Now, in the same way that Silicon Valley Bank targeted startups in the Bay Area, First Republic catered to wealthy clients in coastal cities. It offered them jumbo mortgages, took in their deposits, and gave them 5-star service. This strategy worked incredibly well when interest rates were super low, and First Republic's deposit base jumped 5-fold in the past decade. But when the Federal Reserve began aggressively increasing interest rates last year, those same wealthy depositors started pulling out their money to get higher returns somewhere else. That forced First Republic to pay out higher rates to keep those deposits from fleeing, at the same time that the Fed's rate hikes were reducing the value of First Republic's mortgage portfolio. SVB's collapse triggered fears that First Republic wouldn't be able to meet withdrawals from depositors without unwinding its portfolio holdings at a loss. The stock tanked, which led to more withdrawals. With JP Morgan now the new owner of First Republic deposits and assets, there is a chance the banking turmoil is close to its end. And as the last big bank CEO standing from the financial crisis, Jamie Dimon says he sees the banking system as stable now.
Well, that was Bloomberg's Scarlett Fu on the demise of First Republic. Now let's get straight to a Bloomberg Business Flash with Sam Etienne. Hi, Sam.
Hi, Francine. BP has slowed the pace of share buybacks as lower energy prices trimmed cash flow. The London-based energy giant beat profit estimates thanks to a strong oil and gas trading performance. Despite this, the surplus cash flow it uses to boost investor returns shrank by about 40%. BP says it will repurchase $1.75 billion of shares in the coming months, down by $1 billion from the prior period. And tech giant IBM says it will pause hiring for back-office roles it thinks could be replaced with AI in the coming years. Of 26,000 non-customer-facing roles, CEO Arvind Krishna says 30% could be covered by AI and automation over the next 5 years. IBM currently employs about 250,000 staff worldwide. And Qantas Airways has named Vanessa Hudson as its next CEO, making her the first woman to lead the airline in its more than 100-year history. Currently CFO, she'll take the top job in November, inheriting an airline delivering record profits, but also facing strained relations with customers and unions. And Bloomberg has learned that Morgan Stanley plans to cut 3,000 more jobs amid a deal-making slump. The banking and trading group is expected to shoulder many of the reductions. CEO James Gorman said last month underwriting and mergers activity had been subdued. It's the American bank's second round of job cuts within 6 months. Francine, that's your Bloomberg Business Flash.
Sam, thanks so much. Coming up is the worst of the UK's inflation shock now. In the past, we checked the state of the British consumer next, and this is Bloomberg.
I've always been a person who's just been attracted to hair. I like to sit and think and theorize how I can manifest these visions that I have for braiding and how I can take something that may seem like it's a line drawing in my mind and apply that to someone's scalp.
We are the only culture that has hair that grows out of our head the way that it does. Anyone from the African diaspora is born with this amazingly curly hair that can be shaped into a variety of different ways of expression.
I want Black people to love themselves for how they naturally appear and also to appreciate the cultural practices such as braiding that our ancestors have practiced for centuries.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. The ECB is expected to hike rates, but how high will rates need to go, and how fast will they get there?
Are we underpricing here in Europe, and just how far the ECB could still go?
We really haven't seen an impact from the hiking cycle on inflation yet.
Bloomberg Television and Radio brings you the breaking news from Frankfurt and detailed analysis after ECB President Christine Lagarde's press conference. Coverage begins Thursday on Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, UK shop price inflation has slowed to 8.8% in the year April from a record high of 8.9% in the previous month. The data from a British retail consortium suggests that British households may be past the worst of the inflation shock. Well, we also had manufacturing PMI for April within the past few minutes coming in stronger than expected. Well, here with us, Alex Brazier. He's Managing Director and Deputy Head of the BlackRock Investment Institute. Alex, as always, thank you so much for coming in to make us smarter. I have 1,000,001 questions about inflation data and what central banks do. Is there, first of all, a little bit of a misnomer in the markets that they're trying to figure out what central banks will do without really understanding the trajectory inflation takes?
I think that's probably right. There's no clear narrative right now about how things are evolving. And there's lots of focus on the growth data, as there always has been. But really, we mustn't lose sight of the fact that the defining feature of the world economy right now, certainly in developed markets, is the persistence of inflation, which reflects the fact that those developed markets are overheating because of a mixture of labor supply problems. We've seen it from the US to Australia, all of which mean central banks are raising rates into slowing economies, and in all likelihood won't come to the rescue as economies slow further later this year.
So is the UK ahead of, the Fed or the US in terms of some of the concerning trends that we could see in inflation, or does it just mirror, but it's exacerbated because it's a small open economy?
Yeah, I think some of the features of the UK are actually lagging the other economies. So, for example, retail energy prices are staying higher for slightly longer than in some of the other economies, and that's exacerbating the UK's headline inflation picture. But the thing they all have in common, the UK, Eurozone, US, is that labor supply issues of varying sorts mean their economies are fundamentally overheating. They've got strong wage growth. As a result, they've got strong core inflation, and they face this very difficult trade-off of slow their economies further with rate hikes that they've undertaken in the fastest rate hiking cycle since the 1980s, or live with more persistent inflation. And it's clear that in Europe, central banks are very determined to get inflation down. The Fed has been talking tough, and we'll see this week whether it carries through on that.
I mean, I guess the concern, which is why the markets are a bit muddled up, is also they don't know quite what to do with a possible credit crunch because of the banks, and we had this ECB lending also survey coming out. So is it difficult for a central bank to say, look, this is a market, or this is the bank crisis and what that means for a credit crunch, but inflation is still what I need to fight?
That's right. So the credit crunch, certainly in the US, possibly given this morning's numbers to some extent in Europe, you can think of it as doing some of their work for them. It is probably a consequence of the fastest rate hiking cycle since the 1980s. And in that sense, it's almost by design that central banks wanted to tighten credit conditions. So this isn't the old playbook where tightening credit conditions means central banks come to the rescue. This is the other way round. This is where central banks have deliberately raised rates to deal with overheating economies, get inflation down. So when it happens, they don't come to the rescue from it. This is part of their design in a way.
And is this a new normal? And I don't know whether it actually matters whether we think we're going back to the way it should be, this is like 12 years ago, or whether this is a new reality and whether that changes market psyche.
Yeah, I think we think it's a new regime in general, and you can always be cautious of people calling new regimes, but in a way, that 20 years of great moderation was in fact an aberration. Supply, labor supply, energy supply, goods supply was inexorably growing. So the job of central banks was always just to stoke up demand, to keep it growing in line with supply. Now we're moving into a regime in which we're going to see more frequent supply disruptions. That doesn't mean supply chains necessarily. It means labor supply, energy supply, and even the rewiring of global supply chains all mean more frequent disruptions to supply. And that presents central banks with a much more difficult job than they had for 20 years. They're faced with this choice of keep slowing economies to keep them in line with constrained supply capacity or living with persistent inflation.
Which one would you choose? And also the 2% inflation target, is that still the right number?
I think 2% inflation is still the right number. But what's missing here is a debate about when you face this trade-off, what is the right speed with which to return inflation to the target? You could return inflation to target very quickly, but it would be very costly. You can return it very slowly. That runs risks of losing control of inflation expectations. And central banks have kind of lurched from talking about inflation as transitory to the fastest rate hiking cycle since the 1980s. What's needed really is, in these difficult situations, these trade-offs, is an open debate about, well, okay, here we are, inflation's very high, the economy's overheating, what's the right pace to bring it back? And what's the right trade-off? Always bring it back, but what's the right pace to bring it back?
So what do you think is the right pace to bring it back? And again, why did we underestimate the sticky inflation?
Well, why did we underestimate the sticky inflation? I think it's that initially inflation was transitory. It was the surging goods prices as a result of us all going out less and buying more goods during COVID. That's unwound. That bit truly was transitory. I think the bit that took people by surprise was that underlying labor supply problems in the US, in the UK, and in Europe to some extent, all meant that even though economic activity hadn't really regained its pre-COVID levels or trend, core inflation was the result. And so it was that underappreciation of the supply side that really mattered. And that's what central banks are now really grappling with. What's the optimal pace to bring it back? Well, the standard pace for a central bank is a couple of years to bring it down. That seems to me about right.
We don't have a couple of years, though, do we?
Well, I think if they're clear about what they're trying to do, they actually have a bit more leeway. I think having ignored the trade-off for so long, they needed to reinforce their credibility with these rapid rate hikes. There may be, and maybe this is the benefit of hindsight, but there may have been a better way to acknowledge the issue and have a public conversation about the appropriate speed with which to return inflation to target.
Alex, I know the Bank of England has also been at pains to trying to figure out why there has been a drop of people looking for work. I mean, how much of it, again, do we understand about, not enough skills out there or long COVID and kind of post-pandemic things hanging on?
Yeah, the UK seems to have more labor supply issues than others. Now, in the US, it seems to be that the natural aging of the population and declining participation as the population ages explains a lot of what's happened to labor force participation. In the UK, there's an added effect, which, as you say, relates to long-term sickness, and the understanding of that isn't very good right now, which opens the possibility that it could recover. But right now, the UK faces a much bigger labor supply problem than many other countries, which is why in the UK we've had, on average, no growth for the last 2 years, and yet the economy is still overheating. That's a puzzle on the face of it, but it's explained by these labor supply problems.
How should central banks look at AI? And again, it's always a problem of timeline, right? If we're going to see jobs displaced quite quickly, then it could change also the work dynamic.
I think it could. I think in two ways, really. One is that you always see these big structural changes in the economy, and that creates disruption, also creates productivity growth. over time. And that's one thing that certainly the UK authorities will be wanting over time. The UK's productivity performance has not been great. But the other way in which it confuses life for central banks is they're trying to get to grips with what's happening on the supply side generally. And the more disruption, good or bad, that's happening on the supply side, the more difficult their job becomes. When the supply side is growing smoothly, it's just a case of keeping growth steady. When the supply side is being disrupted in various ways, they're constantly trying to figure out in a forward-looking way, how quickly can they let the economy grow?
Alex, thank you so much, as always, for joining us. Alex Brazier, their Managing Director and Deputy Head of the BlackRock Investment Institute, and we're also recording a special podcast of In the City that will be out on Thursday with Alex, so don't miss that coming up. Also coming up, we're looking at the key piece of Euro area economic data coming out in just a few minutes. We'll have the full analysis for you next, and this is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Our studios in New York and San Francisco, our expert hosts of the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This is a case of a small handful of banks that were poorly managed.
I think part one of the banking crisis is over. I think we have a second wave in commercial real estate.
Does it become systemic? And by systemic, we mean, does it bring down the system as we saw in 2008? I don't think so.
We want, it's in all of our interests to have a safe and sound, trustworthy, reliable banking sector.
We're anticipating a recession at the back end of the year.
I think that we are going to see now a real slowing that begins to happen to aggregate demand.
Well, guests there at the Milken Institute Global Conference reacting to JP Morgan buying First Republic Bank after it was seized by regulators. Now we're just minutes away from key pieces of data for European markets. Eurozone CPI due at the top of the hour. That's ahead of the ECB's monetary policy decision on Thursday. Joining us now is Bloomberg's Maria Tadeo in Brussels. So, Maria, a string of data already out this morning, more coming up in a few minutes.
Yes, Francina, we had, and you've been talking about this on the show, the lending survey for European banks, and what you see overall, and this was always going to be a relevant one, whether without a monetary policy decision, because it was seen as a bellwether, almost as a temperature check of the jitters from the banking jitters that we've seen play out both in the U.S. but also in Credit Suisse. And what you see is that credit standards, quote, tightened further substantially. When you look at the data that was provided in the survey, you see that loans to consumers, to households, to firms, also housing loans, they were majorly down. Overall, what you could say is that this is a picture of cautious. And remember, the European Central Bank had said that they would look into the data, the idea perhaps that that could feed into the euro system, into European banks, and therefore to the European economy. Now, taking it forward to about just 5 minutes time, we're going to get obviously CPI for the euro area. The big number, Francine, as you know, as always, this has been the trend now for months, will be core inflation. Obviously, European policymakers want to see a substantial proof that inflationary pressures, but also the sticky nature of it is fading because of, well, we've seen play out that in the headline inflation, as soon as energy prices go down, that follows. But with core inflation, that has not been the case. It is rather sticky over the past few months.
So why, or we know why this matters for the ECB, but Maria, how much does it matter for the ECB?
Yes, and Francine, you've nailed the question, because by now it's almost granted that the European Central Bank will hike again on Thursday, but the big question mark is at 50 basis points, or will it be 25 basis points? And when you look at the data, and obviously we're waiting for the inflation data to come out in 5 minutes, but if you see one where potentially inflation cools down more than expected, in line with expectations, on top of this lending survey that points to a picture of cautious, you could argue it increases the case for a 25 basis points on Thursday hike. If you do get, and again, we're looking down and counting down to this data, if you do get a surprise to the upside on inflation, it could strengthen the case that there is still way more to go. And remember, 50 basis points, it is still at play. Deutsche Bank says this is a close call going into Thursday.
Maria, thank you so much. Maria Tadeo there with the very latest, of course, on the economy. Now, let's also have a look at what some of the banking companies have been saying, or some of the banks actually have been saying. HSBC reporting some pretty stellar results. The share price is rising, almost gaining 5%, after the lender announced a $2 billion share buyback. You know, a pre-tax profit tripled to $12.8 billion. Bloomberg Surveillance Early Edition continues the next hour with Matt Miller in New York and Edwards in London, and this is Bloomberg.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Lyons.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement
and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Case of a small handful of banks that were poorly managed.
I think part one of the banking crisis is over. I think we have a second wave in commercial real estate.
Does it become systemic? And by systemic, we mean, does it bring down the system as we saw in 2008? I don't think so.
It's in all of our interests to have a safe and sound, trustworthy, reliable banking sector.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong. Our top stories today. The euro drops as the ECB says banks curbed lending more than expected in the first quarter. Inflation data is due now and will shed more light on the ECB's path for rates. President Biden and the debt limit. He's called a meeting of congressional leaders for next week as Treasury Secretary Yellen warns the Treasury may run out of cash as soon as June. And more job cuts on the way at Morgan Stanley. 3,000 positions will be cut as the bank grapples with a slump in deal-making. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Well, the news from the banking sector just keeps coming. Earnings stories dominate here in Europe. And we also have plenty to focus on when it comes to central bank narratives this week then, Matt.
Yeah, absolutely. All kinds of bank news, right? Because you've got consumer-facing bank news, you've got employee-facing bank news, and you've got central bank news that we're all watching very closely. Take a look at what's going on in terms of markets. Almost nothing at all yesterday in terms of the S&P. We were 41.69 at the close on Friday and 41.67 at the close yesterday. So very little change, and we see very little change in S&P futures today. We're down about 0.1% as investors buy bonds. So 10-year yield coming down, but still higher than where we saw it yesterday because it had come up so much. 352.81 is the level we're looking at the 10-year right now. And the Bloomberg Dollar Index is rising again. Okay, it says unchanged, but it had been down substantially earlier. So a big move to the upside once that European bank story came across, affecting obviously the euro, but also the pound and all of the other major trading partners of the Bloomberg U.S. Dollar Index. Bitcoin is coming back up from below $28,000. It had fallen below that level and now is trading at 28,037. So it had come down substantially yesterday, possibly in sympathy with tech stocks. Even though you saw little change on the S&P, you did see a bigger drop on the NASDAQ. We also saw a rate hike from the RBA, which is considered one of the least hawkish banks right now. So if they are worried about inflation, shouldn't we all be worried about inflation? You know, there is maybe less incentive for the ECB to put up a bigger hike because of that bank story, but this tells a story of central banks just not finished with fighting inflation yet. So you can see the Aussie dollar up about 1% right now. The 3-year yield, which is very sensitive to the rate moves by the RBA, is up 17 basis points and had been up even more, right now at 318.80. And then the S&P ASX 200, the benchmark index in Australia, down 9% at the close. And this is the opposite move of what we've seen in most other Asian indexes. For example, the CSI 300 on the mainland in China up 1%. So, Anna, a lot of moves here, a lot of it related, as you said, to central banks, a lot of it related to the economic numbers, and we've got some out of Europe right now.
Yeah, absolutely. So on the theme of central banks focused on inflation, that's certainly that RBA story dominated through the Asian session. And now moving into Europe, we've just got some data coming through in the euro area on the inflation front, so we'll get to that. Euro area April consumer prices rising by 7% year on year. The estimate was for an increase of 6.9%. So at the margin, I guess you could say, because I looked at the core number, and that's come in pretty much in line with estimates, but I suppose at the margin you can say that that inflation print is higher than expected and looking stickier perhaps than had been anticipated. More on that in just a moment. In terms of the broader stock picture then, this is what we see across the European equity markets right now. A bit of weakness coming through. We tried at the beginning of the session to make some gains on European equity markets, and we managed it in some cases, but retreating a little further as we go through this session here in Europe, now down by 0.4% on the CAC 40 over in Paris, for example. What is weighing on markets today, though, is really the energy sector, and we had, if we could just backtrack to that list of assets we had there, we had the energy name BP reporting today. If we could just get back to that, which we can show you the share price movement of. There we are. The BP share price down by 4.5%. This after the business, yes, it reported numbers that came in better than expected, but the buyback was smaller than the market had anticipated, and some of the gains that they made in their trading business were described as exceptional, and as a result, you know, maybe not something that will be repeated. So BP, a weak spot. HSBC to the other side in London, lifting sentiment around the banking sector, a bigger buyback, a bigger profit than expected, and also the reinstatement of a quarterly dividend. All of that, a bit of a fight back against those shareholders who might have been arguing for something radical at the bank ahead of the AGM. Electrolux, this is a white goods manufacturer, of course, here in Europe, and there's Bloomberg, our colleagues at Bloomberg News, carrying a story that we could see some Chinese M&A interest. That stock up 3.5%, was up by 10 earlier on. And back to that euro story, here is the euro, 109.77, and if we show you that session chart, we can see the impact that data that Matt was referring to around lending. This is when we got the ECB's lending conditions survey come through, and it did show that banks across Europe had tightened lending conditions more than had been expected. So if that's the case, does that mean the ECB doesn't have to do so much? So the euro dropped on that news and has since been digesting that and also the inflation print. Joining us now is Bloomberg Europe correspondent Maria Tadeo, who's in Brussels. Maria, so sum up what the data picture looks like then for us this morning. We've had quite a lot of data inputs.
Look, Anna, a lot of data. This was a number that everyone on this side of the world was waiting and looking out for. We have CPI data for the Eurozone, as you mentioned. Yes, the headline number went up a touch on an annual basis in April to 7%, but the number that everyone pays attention to, and a lot of this because of the guidance from the European Central Bank, which has really stressed that they look at core inflation dynamics, as that core inflation number, which now eases to 5.6% in April compared to 5.7% the month prior. It came in right in line with expectations, and I guess for some it could really support the case that maybe that core inflation pressure that we had seen play out in the past few months may have peaked and the trajectory is changing. On top of that, Anna, and you alluded to this, we had the lending survey for the euro area, which again, on a bigger picture, did point to some tightening in those financial conditions. Remember, the European Central Bank had also said they were looking at those for any fragilities that could feed from those banking jitters into the real economy in Europe.
Right. Well, core inflation in line then, but the headline number, which is the one that includes things that we need to buy in order to live, rises or is above the expectation and looks pretty sticky. What does that mean for the ECB, Maria?
Yes, and you know what, Matt? You make a very good point, because when you're in the financial world, obviously we talk about the core inflation, but when I talk to a lot of the normal people, they do say if you strip away the food, you strip away the electricity prices, obviously I would have much more money to spend on a daily basis, but that is where a lot of people on a daily basis happened to have, well, that pressure to provide for those two items. Now, Matt, overall, however, if you put the lending survey on one side and then you add the fact that core inflation did go down, even though you did see this pickup in the headline inflation. I guess you could argue that going into Thursday, the European Central Bank now has a few elements to actually go for 25 basis points to say core inflation has cooled. That lending survey does show that some of the jitters are feeding into some of the European banks, and that could call for cautions in the hiking. It is obvious that they will hike, but the question was, will it be 25 or 50 basis points? Again, you could say that will flip the argument to 25, but we'll have to wait and see, obviously, on Thursday in Frankfurt.
All right, Maria Tadeo, will you be in Frankfurt? Are you going to Frankfurt for this?
Yes.
Okay,
yes.
excellent.
Tomorrow.
Maria Tadeo making her way from Brussels, the European capital, to Frankfurt, the ECB headquarters. Let's get back to the United States right now. President Biden has set a high-stakes meeting with congressional leaders for next week on the debt limit. This comes as the Treasury Department warns a potential default could come sooner than expected. Secretary Janet Yellen writing in a letter to lawmakers saying, quote, "Our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1 if Congress does not raise or suspend the debt limit before that time." Bloomberg's Valerie Teitel joins us now for more. So, Valerie, a warning from Treasury.
Like a warning from Yellen that it could come as soon as June. I'm not sure the markets are prepared for that, and I think it's going to sap risk appetite for the month of May. Now, we go back to 2011's debt ceiling debacle just to get a picture of how volatile it caused the markets to be. The S&P fell by 15%, 10-year yields rallied to 75 basis points, and gold screamed higher. Now, what makes this case today different than 2011 is that investors are worried about not what the markets do trading into it, but what happens to the bond market afterwards, and I'll tell you why. The Treasury has fallen slightly behind on its issuance of long-term securities. At the same time, you're having a ballooning budget deficit due to the high interest payments that the Treasury now has to pay on its debt pile. This means that the Treasury could have to confront the market with a lot more long-term Treasury issuance. Just at the same time, we know that foreigners are pulling back, namely China, pulling back on their Treasury bond buying. So it could be quite a volatile time going in and a volatile time for the bond market coming out as the Treasury readjusts its supply calendar.
Okay, Valerie, so those are the things we know about 2011 and how that could go and taking in Treasury issuance. On the subject of issuance, Monday's session saw a healthy amount of U.S. corporate issuance. What drove the debt-raising frenzy stateside?
A little bit maybe of relief that the First Republic situation is over. There was a huge amount of issuance yesterday, $22 billion worth of issuance, especially coming on today when half of the world was on holiday. 11 IG issuers came to the market, the biggest one being Meta's $8.5 billion bond deal, and it was the busiest session since February. Treasuries didn't really absorb it that well. We saw yields rising across the curve, especially in the long end. 10-year yields rose 15 basis points, caused a lot of the weakness follow through in fixed income markets across Europe today. But we're rallying a bit this morning in Treasuries. That's a signal that a lot of the market has digested the supply.
All right, Valerie, thanks very much. Valerie Teitel will be watching for us, and we will check back in with her tomorrow morning for sure ahead of that Fed rate decision. Now, more job cuts on the way at Morgan Stanley in the midst of a deal-making slump. Bloomberg has learned that senior managers are discussing plans to eliminate about 3,000 jobs by the end of this quarter. Michael Moore, Bloomberg finance editor, joins us now for the details. So, Michael, what do we know about where these job cuts will be in which units?
Yeah, I think you're going to see it pretty broad, to get to that 3,000 number. But, investment banking is where the slowdown has really hit. Deal making definitely took a dive last year and has not shown signs of reviving so far in the higher interest rate with a lot of volatility in markets. So I think that's, where the focus is right now. We've seen other banks talk about job cuts. Lazard last week, Citigroup and others have talked about it. There was a little kind of pause in some of these hiring freezes last month when a lot of Credit Suisse talent came on the market, but it does seem like the economic picture is playing out.
So that's the Morgan Stanley story, in particular around investment banking. Let's just pivot back to what we've learned today with regards to the Asia and Europe giant that is HSBC. In European banking news, HSBC reported first quarter earnings this morning. The numbers themselves beat estimates, as we've been saying. The London-based bank also announced it will buy back as much as $2 billion of stock and will resume paying quarterly dividends for the first time since 2019. Let's listen to the HSBC CEO Noel Quinn, who spoke with Bloomberg after the results.
What I think we see going forward is continued sustainable profits and therefore the potential for a series of buybacks. We've always said that buybacks have a place, and they have a place alongside dividends to distribute excess capital.
Noel Quinn there, the CEO of HSBC. And so interesting then to think about this, Michael, in the context of the pressure that this bank has been under to satisfy demands, quite radical demands from one particular shareholder. Does this earnings report sort of read as a rebuttal, a riposte to the demands that they've been facing?
I think it does. I think HSBC has made the case that, you know, we're profitable and we're making steps in the right direction the way we are structured now. Ping An obviously wants a dramatic kind of breakup of this firm, or at least that's one idea that is being floated out there. But I think, you know, other investors are not, even if they're not on board on that, would like to see more capital return. So HSBC starting this buyback, bring back the dividend, I think that will help satisfy some of those shareholders that weren't all the way in Ping An's camp but had some questions.
Bloomberg's Michael Moore, thank you very much for joining us, talking to us about the banks on both sides of the Atlantic. We'll continue to follow those stories for sure. Let's take a look at some of the other stocks that we're watching here in the U.S. In the pre-market this morning, Chegg is a company you may not have heard of, but they provide tutoring services. They help kids, I guess, to get better grades. And the stock down 45% after warning that ChatGPT is threatening the growth of its homework help services. One of the most notable market reactions yet to signs that generative AI is upending some industries. Also, Lordstown Motors may be forced to cease operations and file for bankruptcy after manufacturing giant Foxconn told the electric vehicle company that it's prepared to pull out of a production partnership. You may be surprised to know that Lordstown is still an operating business. I have never seen one of their trucks on the road. Apparently, there are some. Nonetheless, there may not be many more as the stock drops another 20% in the pre-market. And Dell Technologies, those shares are up 2.3% in the pre-market as Morgan Stanley upgrades the computer company to overweight from equal weight. The analyst Eric Woodring saying that the worst of the PC down cycle is likely behind us, and he expects Dell to outperform the rebound in the PC market. Finally, Zoom Technologies, which is not the video conferencing company, but actually a marketing software as a service company that also collects data for you. It boosted its adjusted earnings per share guidance for the full year. The guidance beat analyst estimates, and so Zoom Technologies, which is an $8.7 billion company, is up another 5% in the pre-market this morning. Anna?
Okay, a lot of pre-market movers then to keep an eye on. Coming up on the program, we'll talk macro. Raffaella Tenconi joins us, founder and chief economist at ADA Economics. How much does the lending data and inflation prints out of Europe change her view on the ECB or not? We'll look ahead to the Fed, of course, as well. Plus, it's day 2 of the Milken Global Conference in Beverly Hills. More highlights from some of our interviews ahead.
We're anticipating a recession at the back end of the year, but the amount of pent-up demand, the amount of the strength of the corporates, the strength of the consumer coming into this, the usual amplifiers of a contraction are not in place. And I think we'll see the U.S. economy, unlike others, pull out of whatever a recession environment could be pretty quickly.
we're investing in a lot of different capabilities and features that makes the in-store shopping experience that much easier, that much more compelling, whether it's price check, browsing inventory in this store, so that we can really make that experience as convenient and as simple as possible.
Convenient, simple, that's sort of what people have needed in the age of COVID. Is that here to stay, or do we go back when finally we all hope that the pandemic will be behind us in some way? Do our changing shopping habits go back again?
What's really interesting about retail in my 20-plus experience is that convenience never reverts itself. Now, the form of convenience has shifted, whereas, say, in 2000 to 2010, a lot of convenience was driven by more stores nearby. Now it's stores in addition to digital. There's nothing closer than the phone in your hand.
News breaks. No one covers the world like Bloomberg.
It would be, of course, a total disaster for Emmanuel Macron because he's been elected on this reform and he would have to basically start from scratch.
It definitely is an exciting day for Apple. First store in India, here in downtown Mumbai, a second one coming up in Delhi.
TK, we've got a lot to talk about.
Debt, China, and the shockingly cautious view the IMF has on the view 5 years forward.
Bloomberg, your global business authority.
Welcome back to Bloomberg Surveillance. This is the early edition. I'm Matt Miller here in New York. Anna Edwards with us out of London. We are looking right now at the relationship between stocks, which I have highlighted here in blue. These are the S&P E-minis, and bonds. These are Treasury 10-year futures in white. Now, the problem that we've had over the last couple of years is occasionally these two assets get very correlated when you have a buy everything or a sell everything rally. And that leaves the 40-60 portfolio or 60-40 portfolio in a really bad spot. But now we've returned to the historic relationship between the two going in opposite directions. Joining us to talk about that is Denitsa Zakova, Bloomberg Cross asset reporter. So the correlation has gone away, I guess, thankfully for average investors, right, Denitsa?
Yeah, of course, if we look at the short-term move, this is 40-day, 60-day, it has actually turned negative since March. And of course, the banking turmoil played a role in this. Investors were looking for safety when it comes to treasuries, and that kind of shifted that correlation. And we've actually seen the 60-40 had a pretty good start of the year. It's up 6.6%. And of course, if that correlation remains negative, that will be a lot more good news for those balanced strategies, including risk parity and other similar balancing between the two. Of course, this will mean kind of a more traditional environment of risk on and risk off, which we didn't see in 2021 and 2022. This will mean going back to equities rallying and then bonds selling off. The two big factors for that are the Fed and inflation. So obviously, aggressive Federal Reserve policy was keeping that correlation positive for a very long time. And if that is still a factor, that correlation can go back to more positive territory. And if inflation remains very stubborn, we may also see that correlation going back to
so we'll watch that. One part of that then is what stocks do and who's buying stocks, Denitsa. And I know that quants, you've been looking at how quants are buying, but there's more skepticism elsewhere.
Exactly. So quants have practically been the only few buyers in stocks in the last few weeks. So systematic traders like trend followers, target volatility funds have been buying up stocks. Obviously, this is based on rules. And just because volatility has been so low, they were kind of pressured to buy stocks in the last few weeks. But when it comes to discretionary traders, which obviously show a lot more sentiment about the market, they have actually been sellers of stocks. And we've seen that reflected in sentiment. Sentiment has turned more bearish. Going forward, the implications of this is the support we saw from systematic traders may not be here anymore because they have been buying a lot of stocks, so they're quite overweight. And the second worst implication is that if there is a sell-off, they will be quickly turning into sellers and amplifying the moves downwards the same way they did upwards.
Denitsa, thank you very much. Bloomberg's Denitsa Zakova joining us there with the latest on the markets. For more market analysis, check out MLIV Go. That's where you find the Markets Live blog on the Bloomberg terminal. This is Bloomberg.
ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
While I like home runs and grand slams in baseball, at A-Rod Corp here, we shoot for singles and doubles, and we definitely never want to strike out.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Coming up on the program, we'll speak to Raffaella Tenconi, founder and chief economist at ADA Economics. How much has the Eurozone lending survey changed her view, if at all, of the ECB and what it will do this week? Will it be 25 or 50 in terms of that hike? We'll also get to the debt ceiling debate, what thoughts she has on that given 2011. This is Bring Back.
About Starbucks for a moment. You've been on the board for how long?
Wow, a long time, since 2006.
Okay, and when you got on the board, did you have to go to Starbucks every day and
I go to
check in?
Starbucks a lot.
And
Yes.
when you check in, do you have to wait in line like everybody
Yes,
else?
I wait in line like everyone else. That's an important part of the process, to see how everything's working, how long it takes, what's happening in the store. I take pictures of the cases. I do all sorts of things when I go in now.
So what's your favorite drink, can you say? Is that a state secret?
I make a joke about this. So I like my coffee black like me.
Okay. Now, Howard Schultz has been a mentor to you a bit. Is that correct? He's the founder of Starbucks.
Sure, for sure. Very important.
So what did he do that made Starbucks so successful? There are other coffee chains around the world, and it wasn't like he invented coffee chains. What did he actually do that made it the biggest in the world?
He really started off from the very beginning saying that he wanted to create a different kind of company and that he had this point of view about leading through the lens of humanity. It sounds like it could be a cliche, but it's not at all. It is very much in the DNA of the company, how we look at things, how we do things. It's always through this point of view of people. And so at the end of the day, I think he put people first, not only in terms of the partners of the company, but also in terms of the customer. And at the end of the day, that is what has made the company so great.
From New York City,
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The ECB says banks curbed lending more than expected in the first quarter, while data this hour shows underlying inflation in the euro area eased for the first time in 10 months, backing the case for a smaller ECB hike. President Biden and the debt limit. He's called a meeting of congressional leaders for next week as Treasury Secretary Yellen warns that the Treasury may run out of cash as soon as June. And more job cuts on the way at Morgan Stanley. 3,000 positions will be cut as the bank grapples with a slump in deal-making. I'm Anna Edwards in London with Matt Miller in New York. And Matt, plenty of stories from the banking sector, as we've already discussed so far this hour. Meanwhile, futures stumble a little bit as we go in search of new catalysts, I suppose, for these markets.
Yeah, absolutely. Waiting for the Fed, after the RBA, may be concerned that the hawkish mood may run around the globe. Check out S&P futures right now, down about 0.2, a little bit less than 0.2%. It should be said that we've rallied up there. We're at 41.67 in the cash trade. Not a lot of movement yesterday, but relatively high levels and relatively high valuations as well. Interest rates are coming back down a little bit, although they came up yesterday. So remember, we were looking at the 10-year yield yesterday, and we were only at 345. Now we're at 352.43, on the way back down by 4 basis points as investors buy some of that debt. The Bloomberg Dollar Index is on its way up. That's a headwind for stocks for sure, and right now it's only up 0.1%, but it had been down significantly earlier, so this is a real reversal. And then you've got Bitcoin hovering right around 28,000. It had come up back up through 28,000. It's now at 27,963 because it had fallen pretty substantially yesterday, 2 or 3% in yesterday's trade. Take a look at some of the pre-market movers. AI plays prominently into one of them, Chegg, which is, I guess, an online tutoring company. It says that ChatGPT is threatening growth on its homework help services, one of the most notable market reactions yet to signs that AI is upending industries. Notable because it's a 45% drop, I think. Lordstown Motors, which reportedly makes an electric pickup truck, may be forced to cease operations and file for bankruptcy after manufacturing giant Foxconn told the EV company it's prepared to pull out of a production partnership. You can see those shares down 25% in the pre-market, but it is already a penny stock. It only trades for 35 cents normally, or 40 cents at the close yesterday. Dell Technologies is up about 2.3% right now. Morgan Stanley upgrading the computer maker to overweight from equal weight. The analysts there, Eric Woodring, says the worst of the PC down cycle is likely behind us, and he expects Dell to outperform a rebound in the PC market. And then Zoom Info, which makes marketing software, data collecting software, and analyzation software. They are boosting their adjusted earnings per share guidance for the full year, beating the average analyst estimate, so up another 5%. It's already an $8.7 billion company. Anna, what do you see in Europe?
We see a bit of softness here in the European session then, Matt, as we get further into this session now, 2.5 hours in. Europe is a little weaker, down by 0.3%. And what is applying the biggest downward pressure? It is the energy sector. Some big energy names losing ground today. BP, the heart of that, down by 4.75% today. This as a result of, yes, the numbers were better than expected, but the buyback was smaller than had been anticipated. This business, these companies coming off record profits in 2022. So people looking for signs as to whether that is repeatable, and the way they describe the trading profits as exceptional, perhaps that suggests that they will not be repeated. So certainly that's a focus for markets. HSBC, though, providing something of a counterweight to the downdraft from BP. So we see that bank is up by 5% in London. Again, it's a story of better than expected numbers and a buyback, also reinstating the quarterly dividend. And the euro, 109.56, and we've been on quite a ride, Matt, today when it comes to euro dollar. And this is a lot weaker than the over 110 that we saw earlier on in today's session. As a result of that Eurozone lending data, a survey of banks suggesting that credit conditions in the Eurozone had tightened. Will that mean that the ECB has less to do on Thursday?
Yeah, very good question. One that we'll put to Raffaella Tanconi right now. She is founder and chief economist at ADA Economics. And Raffaella, this, I guess, is a concern not only for European banks and the economy, but also for the U.S. Are we seeing banks tighten up credit even beyond the tightening that automatically comes with higher rates?
Good morning, everyone. I'm not sure whether they're tightening even and beyond, but they're reflecting what the central banks are saying. Both the Fed and the ECB are still playing the hawkish tone, even though, if you ask me, the underlying data is already suggesting that they have done enough and they should just stay put at this stage. But Lending Standards survey for the Eurozone sent a very clear message. Investment is now beginning to soften over and beyond overall demand and the housing market. So the survey very clearly signaled that the ECB, any tightening from here onwards, it's going to backfire in terms of investment and eventual productivity gains.
Okay, so you already see some signs. Good morning to you, Raffaella. You already see some signs that, well, we all see that survey that credit is tightening, and you think that that means that the ECB does not have to do so much. Has that changed your thinking on what they do on Thursday, or were you always in the camp that they should either stay put or just do 25?
Well, no, we think that they will hike anyway on Thursday because they've communicated to the market, so it's not in their style to really surprise the market. So they will probably do 25 or 50. It's still completely plausible because they have 4% in their head as a key threshold. But the underlying data now for a month and a half, in our view, signaled that they have genuinely done enough. Even though our forecast at the end of 2024 is not yet in line with the 2% target, but you have to consider that we are seeing all of the slowdown of money and lending activity right now. We still have a lot of geopolitics twists coming. We have the AI unfolding that will affect both inflation and the labor market. And we have the new fiscal framework in the EU, which will tighten fiscal conditions next year. So in my view, if you're a prudent central bank, now it's the time to pause and let the economy adjust to all of these moving pieces, which are genuinely really challenging for everyone to plan. But they've already committed.
Yeah. Okay, so they've already committed on that front. Over in the United States, Raffaella, I wonder how much an economist focuses on the debt ceiling debate. We just had a nice opinion piece written by Bill Dudley, formerly, of course, of the New York Fed. And he says that, I have one message for those observing or involved in the standoff over raising the US federal debt limit. Be afraid, be very afraid, so quoting heavily there from 1980s Hollywood. At this point, he says, in the financial and economic cycle, the consequences of failing to reach a deal would be particularly dire. As an economist, what do you watch for here?
Well, as an economist, actually, I think this is a war of attrition. So we think the market will be very nervous in the coming month, but we expect the deal to come at the very end, at the last minute, just because the conditions are so severe if there is no deal. In our view, it may be an interesting beginning of the election campaign that then really unfolds in the following year. And that, to me, is particularly important because it will shape taxation and fiscal matters in coming years. So it's, to me, the longer term issues are the most interesting. But from a market's perspective, you know, the monetary policy, again, it probably would be justified to just stay on the line simply because of the volatility.
Rafaela, what kind of recession are you expecting for the U.S. economy? I've heard a lot of people say that they feel the recession coming is going to be short and shallow with a strong recovery on the other side.
We think that the risk of recovery in 2024 are really getting very slim. So if you look at our forecast and most of the consensus forecast, 2024 looks overall a better year, with the slump coming at the end of this year, maybe at the beginning of next year. But in our view, the risk is that you get a slowdown that is more protected. And the next year is not necessarily a full contraction year, but it may be stagnation, so very close to zero. So that's another factor why, if inflation forecast already today in the US is aligned with a target, there's really no need to tighten monetary policy anymore.
Rafaela, thank you very much. Thanks for joining us. Rafaela Tenconi of ADA Economics. Coming up on the program, the global chip race in focus. We're live in Dresden in Germany as Infineon Technologies breaks ground on a new semiconductor factory. This is Bloomberg.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now, the EU is aiming to produce 20% of the world's chips. Right now, it makes about 10%. Today, Infineon breaks ground on a new chip factory in Dresden, in Germany, the biggest investment in the company's history. Bloomberg's Oliver Crook has been speaking with the company's CEO.
This single biggest investment ever for Infineon. We are contributing to the digital and the green transformation. The products we're going to make here are crucial parts of the electricity chain, from energy generation to storage to conversion in charging, consumption in your electric car. And equally on the digital side, we're going to make it the smart IoT in this consumer industrial space going to happen. And of course, with this project, we contribute towards the target of 20% local production in Europe. We will reduce one-sided dependencies, and therefore it fits perfectly into the landscape.
And so there's funding for the industry. There's a lot of excitement. There's political will. What is still missing, do you think, in order for Europe to achieve what is really a very ambitious target?
I think the landscape is in place, and what it needs now is entrepreneurs to do what we are doing today and to make it happen and to realize and get going. The political framework does exist.
And so obviously these fabs are a crucial part of that, actually generating the chips, but also you need the raw materials, you need a lot of other things, you also need critically labor. Where do you think, do you have everything you need from that perspective?
Labor is going to be a challenge, even though Silicon Saxony now employs over 70,000 people in the semiconductor industry, so it's a good base. We have 9 universities and colleges in the area, but we need to invest. For example, as Infineon, we invest into vocational training, which is crucial for maintenance, right? These machines, which costs tons of money, need to run the whole day, and therefore right now we are educating ourselves, 250 people in vocational training for maintenance. So people are critical. In terms of material and machinery, I think we're going to get it done. We are aligning our plans very well with our suppliers, and therefore I think it's going to work out.
Oliver Cook joins us now live from Dresden. So Oliver, you know, we heard the goals and the aim. What is the significance of this project in German and in European terms?
Right, and so you'll have the Ursula von der Leyen and Scholz arriving here very shortly, really underscoring how much of a priority this is for them politically. And really, these are the chips that are the backbone of the future of the economy. So this is everything from EVs, from wind turbines, and all of these kinds of things. They need a huge amount of capacity in order to double what is already a very ambitious target. So Europe already consumes about 21% of the world's chips. It only produces about 10. And here in Saxony, they refer to as Silicon Saxony, maybe not a term you've heard a lot, but actually 1/3 of all the chips produced in Europe are produced right here. So in Dresden here, Infineon already has 3 factories. This will be the 4th. This is, as we know, as we've been saying, the biggest investment yet, $5 billion for the company. They're hoping to get $1 billion from the German government. And really, as I say, without these chips, you have no prayer in building the wind turbines, the digitalization, all of these things that Germany is really focused on getting strategic autonomy on for the future of the economy.
Yeah, and ensuring the supply chains of those chips are clearly crucial then for Europe, Ollie. We heard you there talking about some of the risks that there could be to meeting these ambitious goals around labor, raw materials.
Right, and so that was what the CEO was really stressing, were the things that the issues that they're going to have are around labor, are around raw materials, and if you have this sort of escalating fight with the U.S. and China, could there be unintended consequences? And the other thing he told me was really what he'd like to see more of is a more coordinated approach throughout the Western world and through liberal democracies. It's a lot of the same conversation we heard around the Inflation Reduction Act, where you have this risk of a sort of race to the bottom, where you're all competing for sort of the same materials, talent, investments from all of these companies, and again, also the labor, as we were mentioning. But also we should mention one other thing, that these chips here, these are the ones that they're going to be sort of building here in the new fab. These are key for the backbone of all of this, these parts of the economy. But what they are not are the hyper advanced chips that Intel, TSMC built, and that is still a whole, you are not going to get away from the dependence from those hyper advanced chips through just these.
Okay, at least these ones are big enough we can see them on TV, though. Oliver, thank you very much. Bloomberg's Oliver Crook in Dresden with the latest on Europe's ambitions in the chip space. Coming up, we will talk more about the earnings stories that we're covering today. Ford is out with earnings later. We'll get a preview, what to expect from the car maker next. This is Bloomberg.
is the best investment advice anybody's ever given you?
You don't need to have a good idea every day. So there's times to be patient and there's time to press.
What do you think is the most common mistake that investors make, the average investor?
I think it's FOMO. So buy high, sell low. You know, and the amount of damage that does the average investor is big.
Let's suppose I have an extra $100,000. What would you say that person should do with $100,000? To put it in an index fund or something else like that?
Yeah, I mean, I think for the average investor, buying an index, but buying and holding and just letting it compound is really sensible advice. I think the more trading someone tries to do, the more damage they tend to do.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, Citigroup CEO Jane Fraser says the U.S. financial system is fundamentally sound, and in her opinion, just a handful of banks were poorly managed. Fraser spoke with Sonali Basak at the Milken Global Conference in Beverly Hills.
It's always a sad day when you see a bank fail, but we are all very pleased to get the major source of uncertainty that was remaining from the recent bank turmoil addressed. And that is a good thing, because fundamentally the US financial system is sound. This is a case of a small handful of banks that were poorly managed, and getting this addressed is very important. When we stood up, I think it's a statement that the major banks, the 11 major banks in the country, in 30 hours put $30 billion to work to buy the time to get the right solution and answer put in place. And that was our intention. It wasn't to provide the answer. It was to give the time for confidence to get restored and our regulators to do their job, which they did.
With First Republic being out of the way now, certainly that was the whale in the room, but what do you expect next in terms of any future bank failures or even hiccups down the road?
So I'm more optimistic around it. I do think the U.S. financial system is extremely strong. The large American banks globally are in an enviable position. Our financial system has a particular structure to it. The large banks, the regional banks, the commodity and community banks. Everyone plays a different role. We play different scale, different customer bases, but it's a strong system. I am anticipating there will be some more consolidation. We do have over 4,500 banks, and it's likely that the minimum efficient scale will rise, but I don't think that brings into question a system that is the envy of the world. This is a strong and highly desirable financial system.
Our Citigroup CEO, Jane Fraser, speaking at the Milken Global Conference in Beverly Hills. Our TV and radio team will bring you more interviews from that conference throughout the day. Now for a look at what else is ahead today. Let's have a look at what is in the diary. Before the US market open, we get earnings from Uber. Then later today, an interview with Uber's CEO on Bloomberg TV. That's at 12:15 Eastern Time. The Federal Reserve begins its two-day meeting on interest rates today. We get the decision tomorrow, of course. Key US eco data includes JOLTS, job openings data, factory and durable goods orders. And Matt, Ford reports earnings after the bell, I'm told.
I'm very much looking forward to Ford earnings after the bell. Wait, after the bell? Before the bell? Is it after the bell? Is it? After the bell, okay. Investors are going to be looking for clarity on how the automaker will reverse losses on EVs that could reach $3 billion this year. And we get a ton of other earnings. Stellantis tomorrow, BMW and Volkswagen on Thursday. It's a hot week for automakers. Craig Trudell, Bloomberg's Global Autos editor, joins us now for more. So, Craig, why don't you just tell us first what you expect from Ford and then, the industry at large?
Yeah, so this will be our first look at Ford earnings since they sort of switched up how they're going to report earnings going forward. In the month of March, they for the first time gave a look at their books broken up for the electric vehicle business and the combustion engine business. And it's really a tale of, distinctly different, states of affairs. The electric vehicle business is, of course, doing a lot of investment. Batteries are still much costlier than combustion engines, and so you see, an expectation for $3 billion of losses in that business for this year. We'll get a first look at, the first quarter for that side of the house. There was a setback in terms of a stop sale for a moment for the F-150 Lightning that I'm sure will be closely sort of looked at for the first quarter. But also, you just generally have heard a lot of, blunt talk on the part of Jim Farley about, needing to be more competitive, bring costs down. And, I think, GM set the bar fairly high last week with a beat and a raise for the year. Of course, all the talk as well about Tesla and pricing on the EV side will certainly be a hot topic as well.
Okay, yeah, that is going to be interesting, isn't it, Craig? Because I was going to ask you what's going to stand out from the European names that Matt mentioned, and there are a lot that will report this week. And pricing at BMW is something that Bloomberg Intelligence references as being interesting. What are you focused on from the European story?
Yeah, I think it's going to be interesting to hear, we'll probably hear a lot of, we're not going to engage in price wars, and a lot of pushing back on this idea that, they're going to be sort of lured into, going blow for blow with Elon Musk. I think it is going to be difficult for these companies to resist, particularly in certain segments. Ford being a good example where they had little choice but to bring the Mustang Mach-E down because it competes so head-on with the Model Y, which has become so much less expensive so quickly. We may see some more, reductions there. On the other hand, the F-150 Lightning, we know that this is a model that, does not have the Cybertruck to compete with, won't anytime soon, at least in scale in terms of, Tesla making quite a few of those. So, we've actually seen them move the prices of those up. So it's going to be a different story depending on the segment.
I mean, I priced out an F-150 Lightning on the configurator, and I can't get much lower than $90,000. Same is true for the BMW iX, a $90,000 electric family truckster. So the prices are incredibly high for these electric vehicles, but I have to say they are impressive to drive, Anna. Craig, thank you very much for joining us.
Okay, so pricing still remains a focus. Craig, yes, indeed. Thank you for being with us this morning. That is it for Early Edition. Surveillance is ahead. They'll be hearing from Gerard Cassidy of RBC Capital Markets. Lots more to discuss coming up on Surveillance. This is Bloomberg.
on countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most. This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
This is Bloomberg.
It just makes sense for First Republic to be a part of a large money center bank like JP Morgan.
The fact remains that there is still a fair amount of stress in the banking system.
There clearly is something systemic here. I think the question is whether or not it's only within banks that interest rate risk has been mismanaged or whether there's a general problem.
It's hard to divorce the Fed's actions from what's happening in the banking sector.
The sad thing is the Fed is going to now regulate these smaller, medium-sized banks when it was Fed policy itself that caused this crisis.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Live from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance on TV and radio alongside Tom Keene. I'm Jonathan Farrow. Lisa back with us tomorrow for the Fed decision. Here's some news to wake you up. A wake-up call from Janet Yellen, the Treasury Secretary. Our best estimate is that we will be unable to continue to satisfy all of the government's obligations by early June and potentially as early as June 1st. President Biden making a move, setting a high-stakes debt limit meeting between congressional leaders on May 9th. And Tom, we just get confirmation moments ago from McCarthy's team. According to a GOP aide, McCarthy agrees to a May 9th meeting with the president.
I am wrong on this. I am hardwired to ignore it, and I'm wrong. And this, everybody tells me, the pros tell me this time is different. And what's more important, John, the market tells me this time is different. There's some real oddities in the short-term paper market, that trust market, that indicate the tension to May 9th.
Well, let's get to the markets in just a moment. Let's compare and contrast two things. The urgency of the message that came from Treasury yesterday in a letter to congressional leadership. One, June 1st. Compare that with the lack of urgency around meeting with congressional leaders, May 9th. Why do we have to wait a week from now, for this, if it is so urgent?
They're going to have a May 9 meeting to decide who kicks the can down the road. Greg Valliere publishes on it this morning with many others saying the short path here, John, is to kick it out to September or maybe out further. But the answer is the American tradition is to move it down the road. And that's who's going to kick the can? Is the president going to kick the can? The speaker? Senator Schumer? He's qualified.
How much road is left?
Well, that's the key question. And this goes to the debt dynamics that infuriate the conservative Republicans. The answer, I think, across all the spectrum of the Bloomberg surveillance world is you need to grow your way out of this. How do you grow your way out of this with 1% GDP?
So here's the market question. Does this bleed beyond just the at-risk securities in the T-bill market? Does it go beyond that?
The tape is talking to me. I mean, the resiliency of the equity market, SPX near 4,200. I got a Dow print right now of 34,000 close yesterday, on and on. The VIX was a 15 handle at one point. The market is doubting the urgency and the angst of this. Makes for great theater. You know, I guess they'll do an Oval Office shot and everybody will be cozy and, you know, comfy. Maybe they should have Roy Woods Jr. show up to run the meeting.
I'm sensing from you that you're still not taking this that seriously.
No, I'm not. I mean, the comedian that was at the White House dinner, I thought he was one of the best in 15 years. He and Sinbad. And you can have Sinbad or Roy Woods Jr. show up and it'd be a more constructive meeting.
Possibly. Let's get to the equity market. Equity futures just a little bit softer, negative 0.2% on the S&P 500. On the NASDAQ, we are totally unchanged. And I have to say, even with the deal yesterday, Tom, between JP Morgan and First Republic, no relief rally for the banking sector, no relief rally in the equity market more broadly, totally unchanged going into the Fed.
Yeah, I'm sorry I missed yesterday's festivities. We'll pick it up today with some really good insights. Stay with us, folks, for JP Morgan, First Republic through the morning. I'm looking at LIBOR. I go back old fogey to 3-month LIBOR, and I'm sorry, it is ascending persistently. It's a grind higher in short-term rates into this Fed meeting.
Important couple of days ahead. Two-day meeting begins in Washington, D.C., concludes tomorrow. Full coverage, of course, here on Bloomberg TV and Bloomberg Radio. Then it's on to Friday with the payrolls report, and somewhere in between, an ECB decision and Apple earnings after the bell on Thursday. Looking forward to that. Joining us now is Jonathan Stubbs, equity strategist at Berenberg. John, you know where I'm going to go with this. TK is thinking this is the same story all over again. They meet, they complain, they kick the can, but ultimately there's not a big issue with the debt ceiling. Is that a complacent way of looking at things? Are you concerned? Should we be concerned about what's about to happen in Washington?
I'm not sure whether it's the debt ceiling itself which should be, you know, the focal point of concern, because there are many other aspects to this I'd bring in. You know, when have we had sort of debt ceiling concerns at the same time that we've had such an inverted yield curve in the US, at the same time that we have a banking crisis with some of the biggest banks failures in history happening alongside that, and also having the US equity market trading north of 18 times forward earnings, where those are peak multiples, excluding the liquidity bubbles of the last 50 years. So it's not just the debt ceiling; it's everything else that goes with that. And the final point is, what's happening in the rest of the world. We're talking about deglobalization. We're talking about frictions between the biggest economies in the world, US and China, on many levels. So the debt ceiling is one thing, but it's happening at the same time as everything else. It's everything everywhere all at once.
John, I want to address contagion this morning. One of the things I've started doing, this is in the last 90 days, folks, is I read the wonderful publication Cranes. They're in different cities around the country. One of their headlines today, Jonathan, Manhattan has almost 94 million square feet of available office space. Is one of the bank variables here, your expertise, is in Europe? Is commercial real estate challenged in Europe?
I was looking at this actually from a US perspective again for a big piece we put out last week, and it's the Castle back to work data that you publish or you have on your platform, and you look at that across all US cities, and it's running between 40 and 50% compared to a pre-COVID level. So we have this phenomena in Europe, in the US, around the world that. We haven't gone back to normal in terms of using office space and everything. There's a lot of sort of vacant property, and there's also more capacity being built. So commercial real estate is a key sort of risk focal point wherever we are, and I think in particular into the US banks more so than into say the European and UK banks. The lack of breadth in terms of liquidity coverage across the entire banking system in the US appears real time to present more fragility. High levels of regulation, higher liquidity coverage ratios in Europe suggest greater protection. But I think your broad point is spot on, and I'd reference this of Castle back to work because it sort of sits alongside. The empty space, the additional supply that's coming on. People just haven't gone back to work, and then you put on AI into that, and IBM over the last 24 hours saying, we're cutting back and we're going to sort of replace open positions with AI. There are lots of challenges happening here at the same time, but commercial real estate looks under pressure.
Do you assume, Jonathan Stubbs, that American banking will become more Canadian and more European? I mean, I put out a tweet yesterday that JP Morgan and Bank of America combined is the fifth bank of the United States. I mean, that's really where we're heading. But do you see consolidation here just inevitable to occur?
Yeah. There's some, there's some great sort of financial specialist groups out there. I think many of your viewers, I'm sure you look at the Cabesi letter, I think it is. They had a great sort of picture over the last of 72 hours of the Spanish banking system and how that's consolidated over the last 10, 15 years. So we know consolidation in banks has been sort of running consistently over the last of 30, 40 years, to be fair, but it's really accelerated in Europe on a needs-must basis since GFC. And now we seem to be running into that in the US. So, consolidation is happening. It's happening because banks are fragile in this fragile world. And the too big to fail are reaping the benefits of getting attractive businesses at a good price with liquidity backing from authorities. So, so far that's intercepting the downside risk or passing it on. Moral hazard is a different matter within that. And it doesn't solve some of the underlying sort of risks coming through from higher rates and what that means. It doesn't solve some of the gap between money market rates and deposit rates, and more people waking up to the fact that they can get higher sort of rates from deposit markets. So there are still risks there, but so far authorities are sort of plugging the holes.
Brilliant piece from John Authors today.
Yes,
on Bloomberg.
yes.
Absolutely fantastic. In this piece, if you haven't read it yet, there's a quote here from a professor from Cornell, Robert Hockin, and Tom, it reads as follows. We now have two choices before us. Either we preserve our production-focused regional and sector-specific industrial banking systems by removing FDIC limits immediately, or we allow financialized Wall Street banks to take all, an outcome that would ultimately necessitate nationalization of the whole sector.
This is the heart of the matter, back to the second bank of the United States, the battle of Henry Clay and Andrew Jackson, Kentucky and Tennessee. And John, the author's piece is an absolute tour de force. It'll be a focal point here through the week.
Jonathan Stubbs, I want to give you a final word on that. The banks in America, do you see reasons to buy the regional banks in America? Because they've really struggled to get off the mat over the last couple of weeks.
Short answer, no. Slightly longer answer, from our models, we've got a bank's handbrake factor in our sector models that we look at across all regions. We've got that weight higher in the US for obvious reasons of what's happening real time. And that takes banks, towards a sort of middle rank, so sort of a neutral rank, which isn't being sort of selected within the sector. That contrasts with UK and Europe, where we still have this sort of risk factor on banks in our model. But banks are our top one or two sectors in our sector models in Europe and the UK. Again, better capital, better liquidity in terms of breadth across the system, more consolidated already. So our models continue to point to this preference for UK and European banks over the US. In the US, one final point, defensive sectors in the US equity market have never been this cheap going into a US recession. I think that's interesting. So you can actually get quite good protection in US equities in defensives into a recession. I think that's a really good trade to put on at this point as we go into the summer months.
Phil, we've been talking about this US recession for 12 months.
Jonathan
Stubbs there of Bloomberg, and still waiting and wondering whether we're in it right now. Big move yesterday in the ISM manufacturing number. The prices paid component of that seemed to spook this bond market.
Yes.
Throw in the Meta bond issuance as well. We had a real repricing of the yield curve yesterday, TK, even when the equity market didn't do much at all.
Well, it's there, but far more importantly, I would say it's tick by tick, day by day. You look at the correlations here of equities, bonds, currencies, commodities, and you end up going to the Bramo market. You go to the spread market, and I'm looking at very short, I've mentioned this before, 3-month papers compared to the 10-year note, and we're right down near record inversion on that, and that's this distortion. Is it the debt thing? Yeah, it's the debt thing. I'll go with that. But it's much more, John, to bet on what inflation's going to do and if the job market will allow Powell to relax. And, in the last couple of days, you're right. It's become more restrictive.
Equities right now on the S&P 500, negative 0.2% on your equity market. Looking ahead to another big week for equity market earnings. Anna Han of Wells Fargo on stocks coming up in the next hour. Looking forward to that conversation. Equity futures just a little bit softer from New York City. This is Bloomberg.
Keeping you up to date with the news from around the world with the first word, I'm Lisa Mateo. President Biden has set high-stakes meeting for next week on the debt limit. The Treasury Department warned that a potential default could come sooner than expected. The president will meet with congressional leaders. Republican Kevin McCarthy, the House Speaker, has said he won't extend the debt limit unless there are trillions in cuts to the federal budget. Underlying inflation in the euro area slowed for the first time in 10 months. After stripping out volatile items like food and fuel, consumer prices rose 5.6% from a year ago in April. That backs the case for the European Central Bank to slow its most aggressive interest rate hiking campaign ever later this week. The White House is considering promoting Federal Reserve Governor Philip Jefferson to vice chair. Bloomberg's learned that a Latino candidate could then be named to an open board slot. Jefferson was confirmed by the Senate last year with broad bipartisan support, and that suggests he would face little opposition to becoming the Fed's number 2. The White House National Security Council says Russia has suffered more than 100,000 casualties since December in the fight over Bakhmut in eastern Ukraine. Now, that includes 20,000 dead. The commander of Ukraine's ground forces say they have pushed back Russian troops from some positions in Bakhmut. Writers of some of the most popular shows on American TV are walking off the job. Writers Guild members are striking for higher pay at a time when there are rapid changes in the way people watch TV programs and films. One of the writers' demands is for higher payments for shows that are on streaming services. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Lisa Mateo, and this is Bloomberg.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Everyone's looking for another rate hike.
They're going to be looking at the momentum of the economy.
It's not too hot, not too cold. The Fed's kind of stuck in the middle.
But will they signal a pause?
A dovish hike would ease financial conditions. A hawkish hike could destabilize things.
The parlor game of the American economy.
Trust Bloomberg for the fastest coverage and exclusive analysis.
Certainty has gone up. Certainty has gone up a lot.
The Fed's goal is not to send the economy into a deep freeze.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg, your global business authority.
Very pleased to get the major source of uncertainty that was remaining from the recent bank turmoil addressed. And that is a good thing, because fundamentally the U.S. financial system is sound. This is a case of a small handful of banks that were poorly managed, and getting this addressed is very important.
James Fraser, the Citigroup CEO, yesterday at the Milken Conference in California. Based on some of the commentary of the last 24 hours, you probably wouldn't realize that we've just seen the second biggest banking failure in the history of the United States.
Thank you. Thank you. Thank you. I totally disagree with her. I understand she's a corporate officer. a public person. She's got to say the right thing at the right time. I'm glad that General Fraser was able to calm the troops. Guess what? Baloney. Everybody I talk to, it's about commercial real estate. That's one angle of it. And frankly, John, it's still about distorted interest rates. I think it is underplayed that the events that got First Republic and other banks into this mess still exist. And, you know, the idea that there's no other banks out there, I really have trouble with that.
You saw what Charlie Munger had to say about the banks in America,
He's got a little
some of the regionals, speaking to the FT over the weekend, basically suggesting they're full of bad commercial real estate loans. You heard from Katie Koch and Milken yesterday, the TCW Group president. You remember her from Goldman Sachs Asset Management over many years. She said regional banks is an area we're concerned about because of deposit flight, and also they have the highest exposure to commercial real estate.
I'm just going to listen to pros. And I mean, you know, our next guest is one of those guys. They've seen all this. You know, I mean, Gerard Cassidy was out front on the doorsteps of Continental Illinois a few years ago as they were going belly up. He remembers it.
Can I just say, we joke about analysts coming on calls and saying great quarter. Can I say great call to the analyst, Gerard Cassidy?
Yeah.
A great call yesterday, on the analyst call yesterday with JP Morgan. I just think fantastic line of questioning that he addressed with leadership there.
Well, that's the experience you get. And with us now, and he's helped us so much. I think of Ken Leon over at CFRA, Michael Mayo, when we can drag him in. Gerard Cassidy up early in London, head of U.S. Bank Equity Strategy at the Royal Bank of Canada, and we welcome him this morning. Gerard, I'm going to go to the PowerPoint. I thought it was really quite nicely done by JP Morgan. I'm sure it was massaged by a staff of 42. And buried at the bottom was an internal rate of return guesstimate of 20%. You and I aren't going to go to an iterative discussion of the equation, but I fell off my chair. Is this really an IRR at 20%? Is it that lucrative for Fortress Diamond?
Tom, it is, and thank you for having me on the program from London here. And I would point out that one of the reasons the internal rate of return is so strong is that in an agreement with the FDIC, which is very common, the FDIC, when they sell these banks out of receivership, will take a loss-sharing agreement with the buyer. As a result, when you have one of those loss-sharing agreements, the amount of capital that the bank is required to hold against those assets goes down. And that's one of the reasons the IRR is as strong as it is.
What kind of pop do you calculate JP Morgan will get if interest rates actually come in, if we disinvert, if we get ourselves back to some form of normal interest rate structure? To me, it's an incalculable delta. It's just a huge number if they get the markets to cooperate.
You know, Tom, you really put your thumb on it, because if you go back to 94, 95, and I'm not suggesting we're going to have that Goldilocks economy we had in 95, but Greenspan took rates up from 3 to 6%, and we didn't have a recession. And then he started cutting rates in 95. The bank stocks were up 55% that year. So if we don't have a big recession, as many people think we are going to have, the credit problems for the banks will not be that severe, and rates will start coming down probably next year.
You and I studied at the altar of Henry Kaufman. He was so kind to me when I first joined Bloomberg, Mr. Cassidy. Henry Kaufman is quoted by John Authors. Folks, Matt Levine, John Authors, read him today if you're part of Global Wall Street. And Mr. Authors talks about Kaufman as a quasi-public utility. Is that what we've got now with a combination of JP Morgan and Bank of America? Are they a public utility?
Tom, you know, I wouldn't refrain too much from saying that, but other than to say they're financial utilities, and that's not a negative, that is a positive. If we could have banks that consistently pay their dividends through the cycle and also deliver, you know, mid to lower teens return on tangible common equity, those are very attractive returns. So you could call them financial utilities, in my opinion.
Great for shareholders. I wonder if it's great for customers. Jared, let's talk about that. The deposits that they're assuming, JP Morgan from First Republic. You asked about this on the call yesterday. Jared, how do those deposits reprice? Did you get some clarity on that?
John, what happens normally in bank failures, quite often the acquirers are able to renegotiate down those rates of interest on those deposits. Not the term CDs, those are contractual. But that was the reason for the question, because that makes the deal even more attractive to JP Morgan. And quite often, and I'm not saying this happened with First Republic, but quite often what happens when these banks head into receivership, they have to pay up for deposits to bring money in. That's why the buyers get to reprice them downwards, what makes it more profitable for the buyer.
I love the way that Jeremy Barnum, the CFO of JP Morgan, addressed this. Listen to this language. I think the reprice experience will blend over time into the rest of our deposit franchise. Do you know what that means, Tom? Their deposits and their rate of return will come down to zero over time, because over at JP Morgan, Jared, they're not paying much for deposits and they don't need to. Jared, I was wondering yesterday whether you thought they were downplaying to some extent, for PR reasons, just how profitable this deal might be for JP Morgan.
John, I think you said it well. I think it's an extremely profitable deal for JP Morgan. Their size and their strength gave them the advantage. We wrote last night in our research note on this transaction that the prior two transactions, the loans were marked to market to about 77 cents on the dollar. And in the case of JP Morgan yesterday, they marked them to 83 cents on the dollar. So they didn't have to be as aggressive as maybe some of the other bidders who were bidding on this, and that was an advantage they had.
There's the math, folks. You get it from Gerard Cassidy, not from us. We go to the pros, and John, you got a bond at par or a loan at par down to 77 cents, and JP Morgan paid up where the others wouldn't.
So, Jared, they've got experience of dealing with distressed institutions, Washington Mutual, Bear. Jamie Dimon's been there, done that. Jared, you addressed that question as well. Why is this so different, and why in 5 years won't we be sitting here rethinking everything we've just said in the last 24 hours?
John, the major difference, and Jamie Dimon addressed this yesterday to my question as well, which is this was a deposit flight, deposit run problem. It was a classic duration issue of long assets on duration, short on funding. This was not a credit problem. And First Republic had pristine credit. And I would suggest that this is a very different situation. As a result, it's not as risky for JP Morgan and the others because this is a mismatch of assets versus liabilities, and they're now going to benefit from the marking of market of those assets and the yields that creates.
Jared, wonderful coverage, as always. Good to see you in London as well. Gerard Cassidy
Thank you.
of RBC Capital Markets. Thank you, Gerard. At a more civilized time for Gerard, given that it's about 11 a.m.
Maybe he's over-advising Tottenham. I could see Cassidy bringing in
They could
Cassidy,
use his advice right now, given the way things are going.
Yes, I think that
I love the way that the
true.
CFO responded to his questions yesterday, Tom. They said this about how clean the bank was. You basically get in a very clean bank in the most clean way that you can get it. That doesn't mean there's no risk. It just means you have a very clean bank in the cleanest way you can get it, that it didn't have those problems, referring to the problems, of course, of Bear and Washington Mutual back in the day.
And they get us, I like the single sentence someone had. I'm sorry, I can't cite it, but they get a Silicon Valley franchise overnight. Years and years to build that out, and instantly they get it. And they go in and they go to the right club and they have the right lunch, and I don't need to be cynical.
You don't sound cynical at all.
Can we get some Giants tickets? I need get me some San Francisco Giants tickets now.
Don't we want some Lakers tickets? No?
Lakers tickets?
Basketball, Tom.
That's not Los Angeles.
We're not going to LA?
No.
No? California? No?